markets have wanted tax cuts and markets want fiscal responsibility.
The market is laser focused on these negotiations.
So much uncertainty is built into the market.
This is going to be the most expensive bill in U.S. history. And so how are we going to offset?
If we get big deficit numbers coming out of this tax bill, I don't see how equity valuations hold here.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday as the U.S. receives a downgrade.
I think that Moody's is a lagging indicator. I think that's what everyone thinks of credit agencies. We didn't get here in the past 100 days. It's the Biden administration and the spending that we have seen over the past 4 years. And we are determined to bring the spending down and grow the economy.
The White House pushing back as Moody's strips the United States of its top credit rating. The move hitting just as President Trump's big, beautiful tax bill advances in Washington happen to send equity markets lower and 30-year bond yields back through 5%. The dollar is weaker. Bond yields are higher.
This is the wrong kind of mix, given the fact that we have both bonds and stocks and the currency selling off. And it really highlights how the fiscal deficit is coming very much to the forefront. And Scott Besson is not completely wrong. That in general, this is a lagging indicator. And we've already seen S&P and Fitch downgrade the credit ratings of the United States. However, what you see, the Wall Street Journal, the stark math in the GOP tax plan, it doesn't cut the deficit. The Deutsche Bank, at this stage, there are no signs of any serious deficit restraint. And you're talking about $1 out of every 7 that the U.S. is currently spending that's going to interest payments that is greater than the expense for the Defense Department.
As you say, Lisa, the Treasury Secretary is absolutely right. And Moody's references successive governments. We've been running budget deficits of 6%, north of 6% of GDP in good times, not bad times. The question for this administration and Republicans down in Washington, D.C. is, have you got a plan to do something about it?
Well, they have a plan to spend more. When you look at how this is going to be tallied up, you're looking at potentially $4 trillion over the next 10 years. The question I have this morning is, does this give momentum to the deficit hawks that at the moment, when they voted last night, they said they're just going to vote it through, they're going to stay on the sidelines, not a yay or a nay, just that they abstain, and it goes to the next Rules Committee. But they are putting out messaging that this is not enough to tackle our deficit, and this fight is going to continue and linger.
So for markets, we've got two examples. August 2011, the downgrade from S&P. August 2023, the downgrade from Fitch, each with distinct backdrops, each with very different market outcomes. Lisa, there seems to be a belief that at the moment this is probably something closer to August 23 than August 2011.
2011 was a shock. It came as a surprise. You saw a real knee-jerk, pretty big drawdown in the U.S. equity market. People do not expect that to be the case this time around. Pretty much everyone's saying, well, how is this a surprise to anyone? We've been talking about this for a long time. That said, on the margins, to the extent that it causes anyone to pull back, Christine Lagarde, did you see over the weekend, she came out and she said, right now, the euro in the strength reflects, quote, the uncertainty and loss of confidence in U.S. policies among certain segments of the financial markets. So international leaders can have a rich opportunity to comment obliquely on U.S. policy.
Yeah, I picked up on the same quote, throwing some shade there just a bit with euro-dollar at 112.81. Dollar story is interesting. I find it also equally as interesting that you're not seeing a bid in German bonds. You don't see that in JGBs. In fact, you're seeing a repricing of yields higher around the world. So there's no haven bid in one particular bond market this morning.
It's a wonderful point. Essentially, this bond market globally and the developed market rises and falls together, which is the reason why you see emerging markets maybe diverging to some degree. But we saw that on the way down with NERP and ZERP and all of these very low rate policies. And maybe now you're seeing that on the way up, especially with a fissuring in global trade and the potential ramifications for inflation.
We've got a lot to work through this morning. On a 5-day winning streak on the S&P, we snapped that. S&P 500 futures negative by close to 1.3%. Coming up this hour, we'll catch up with Bob Dole of Crossmark following a U.S. downgrade from Moody's, Jeannette Lowe of Strategas as the one big, beautiful tax bill advances, and Andrew Bishop of Signum Global Advisors with Trump and Putin set to speak later on today. We begin this hour with stocks and bonds falling as the U.S. loses its top credit rating. Bob Dole of Crossmark writing a rebalancing of portfolios away from the U.S. should persist as the premium equity valuations associated with the U.S. exceptionalism theme have further to unwind. Bob joins us now for more. Bob, welcome to the programme, sir. You lived through it. We all did. Just how relevant was that August 2011 experience to where we are right now?
Well, it's more of the same. I agree with the analysis you just had about what was a surprise and what wasn't. But we're marching slowly but surely, some would say quickly, to a point of no return. We're paying no attention to the debt and the deficits. The bill that's about to go through will raise it by trillions more. And at some point, there's a day of reckoning, and that U.S. exceptionalism is tied to that.
So, Bob, the bill down in Washington is advancing. Do you believe there is a level at which this begins to constrain the ambitions of Republicans in Washington? And if it's not 5% on the 30-year bond, what is it?
That's a great question. I mean, the 5 on the 30-year and 460 on the 10-year has been for technicians point of concern, yes, for the bond market, but also for the stock market. Can we support those kinds of levels? And of course, you're getting all kinds of blinking by hawks on the deficit in Washington, D.C. Look, the alternative, of course, if we don't pass a bill, is the largest tax increase in U.S. history on December 31st, and nobody wants that either. So we're between the proverbial rock and hard place.
At this point, Bob, as a market participant, do you buy the blinking, the sense that there will be some capitulation on the part of Washington, D.C. to the deficit hawks? Or do you say this is a different and kind of existential concern that causes you to really back away from any movement that we're seeing, any sell-off in the bond market?
Lisa, I think that the bond market is sending a message. The message is you can't do this forever. And we're trying. We're trying really hard. Look, if the stock market weren't selling at 21 or 22 times, demanding near perfection, you might blink and move the other direction. But the stock market can't take much bad news at these kind of valuations.
There's this concern between the rock and a hard place, Bob, and it raises really one of the ultimate questions for the market right now. What is the bigger risk? A sort of dramatic deceleration in growth, whether it's a policy shock on the budget side or whether it's some sort of policy shock on the trade side, or some sort of acceleration in growth but fueled by increasing deficits and what some people could argue as fiscal irresponsibility?
I'm still concerned about the slowing of the U.S. economy. We have that fight, Lisa, as you know, between the hard data and the soft data. The soft data mostly falling off a cliff, the hard data kind of hanging in there. But we know hard data usually follows soft data. So either the soft data have to recover nicely, they may do some of that, or the hard data to fall, and I think it's going to be a bit of the latter. And we're going to have earnings estimate cuts, which we don't need it 21 or 22 times.
Bob, you have the Treasury Secretary over the weekend saying he doesn't put much credence into the Moody's report. But do you think the Moody's downgrade can actually change votes in Congress?
That's a great question. Look, I think it will change the dialogue to some degree. The deficit hawks will have a louder voice and probably think, well, maybe this is our chance to make a difference. We'll see. They obviously voted present rather than no to get to the next stage. But this is not pretty. Let's see how the bond market does. And that will be a signal to those legislators about how hard they should, how hard a line they should take.
Yeah, some like Congressman Chip Roy voted present, but he's also in the next hurdle. He's in the Rules Committee. He voted present in the Budget Committee. So potentially has a change of heart overnight, depending how the market does. If it was to potentially mean that we could see some votes change, trigger some votes down in Washington, D.C., where do you think it would come from? Where would they cut?
Yeah, that's a great question. Look, I think they'll try the best they can to cut the spending in the out years so it's easier to reverse later on as opposed to doing things now, which is a lot of smoke and mirrors, but you know that's the way they tend to operate.
Bob, all these reasons to be bearish bonds, are they good reasons to be bearish stocks as well?
Well, yes, I think the reasons are, look, the stock market has a problem. The bond market has a problem with slowing economic growth and potential further earnings cuts, and the valuation. You put all that together and, you don't have to be bearish, but boy, it's hard to be bullish.
But the retailers have got a problem as well. Let's finish on those retailers. Some of them report later on this week. We'll hear from Home Depot. We'll hear from Target as well. This White House is piling on the pressure on Walmart and sending a warning, I think, to retailers across this country that if you raise prices, we're going to make public relations for you very, very difficult. What do you think that means for pricing strategies across corporate America?
I think they will still have to raise prices. You know, the retail business has very low margins. And so when there are cost pressures, it's hard to eat them. They'll eat some of it probably with all this pressure from the White House, but by and large, they're going to have to raise prices if their input costs are moving up. And for a lot of reasons they are, most related to the trade.
Bob Dole of Crossmark. Bob, appreciate your time, sir. As always, the president over the weekend, eat the tariffs.
Yeah, really angry about Walmart saying you're going to come out, you're going to blame that on tariffs. Scott Bessent pushed back a little bit on some of the Sunday talk shows. Treasury Secretary Bessent came out and said, yes, Walmart's going to eat some of the tariffs. They're also going to have to pass them along. He conceded, and he said, Doug and I have a very good relationship, and talked about how it was a conciliatory discussion to really get more information rather than to jawbone him. It's sort of this good cop, bad cop that they have going on right now.
And the Treasury Secretary said this is the most draconian measure that they have to offer because of SEC rules to their investors. They need to say what could be the worst, kind of throwing some cold water on that. Actually, for Walmart, this is going to be the worst case scenario.
This is the world we live in right now. You had that report several weeks back about Amazon breaking out the tariff costs. What happened? The president called Jeff Bezos. What happened this time? The Treasury Secretary called the CEO of Walmart to work out what was going on.
If Walmart, though, does raise prices, that gives a real free ride to the other retailers to do the same. And that's the reason why Target and TJ Maxx and all the other retailers that are reporting this week are going to be crucial to understanding just how much power Walmart gave to them to say the same thing.
It's quickly becoming a big feature of earnings season for the retailers. We'll hear more from the retailers later on this week. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. The House Budget Committee approved President Trump's tax and spending package after Republican hardliners won over party leaders to speed up cuts to Medicaid health coverage. The bill now heads to the full House and then to the Senate, where the deeper Medicaid cuts and other provisions face scrutiny, if not outright opposition. Meanwhile, President Trump is set to hold a phone call this morning with Russian President Vladimir Putin. That's after Ukrainian President Volodymyr Zelensky met with Vice President J.D. Vance yesterday at the Vatican. Secretary of State Marco Rubio says President Trump is prepared to back new sanctions on Russia if today's talks don't go well. And former U.S. President Joe Biden has been diagnosed with an aggressive form of prostate cancer that has spread to his bones. According to a statement from his office, the president and his family are reviewing treatment options with his physician. Biden is 82 and left office in January as the oldest president in history. That's your Bloomberg Brief. John?
It goes without saying, we wish the president all the best. Yahara, thank you. More from Yahara later on this hour. Up next on the program, advancing Trump's tax bill.
The plan is to move it to the Rules Committee by midweek and to the House floor by the end of the week, so we meet our original Memorial Day deadline. I think it's going to send a very important message of stability to the stock market and the bond markets.
They're maintaining that aggressive timeline. It's sending a signal to this bond market, all right. We'll get into it in just a moment with Jeannette Lowe of Strategas, live from New York City this morning. Good morning. The message from Mike Wilson of Morgan Stanley this morning. Buy this dip. Here is the dip. Equity futures on the S&P 500 negative 1.3% following a 5-day climb on the S&P 500, posting a 5% plus advance on the S&P last week. We break that streak so far this morning. In the bond market, just check this out. This is the ugly mix we've been talking about. Yields up, dollar weaker. Yields up 8 basis points at the very long end of the curve, through 5% on 30s. Dollar weaker, euro stronger, 112.78. U.S. assets, once again, trading in one bucket.
And this is because ultimately you have a downgrade just simply underscoring the concerns around fiscal as well as some of the trade policy uncertainty. That 1-2 mix is the reason why a lot of people have gotten really nervous.
The focus on the tax bill down in Washington under surveillance this morning, advancing Trump's tax bill.
The plan is to move it to the Rules Committee by midweek and to the House floor by the end of the week, so we meet our original Memorial Day deadline. I think it's going to send a very important message of stability to the stock market and the bond markets, and as I mentioned, to job creators and entrepreneurs and risk takers. This will be the pro-growth economy that we have been waiting for and that the American people voted for. We're going to deliver on this, and we'll get everybody in line to do it.
So here's the latest this morning. A key House committee passing President Donald Trump's tax bill overnight. Republican hardliners allowing it to advance after party leaders agreed to speed up Medicaid cuts. Joining us now from the nation's capital, Tyler Kendall. Tyler, Memorial Day a week away. What needs to happen between now and then to advance this bill?
Yeah, hey, John, good morning. Well, a few different things need to happen because, to be sure, while fiscal hawks say that they have in writing from House leadership some of these plan changes, including moving up the timeline for Medicaid work requirements, rolling back some of those clean energy tax credits, the bill text itself has not yet been changed, which really does mean that negotiations are ongoing here. We are expecting those changes to happen when the Rules Committee meets. That's on Wednesday, set for 1 a.m. Eastern, where we could see any of those details emerge. And while fiscal hawks did get to bolster their argument in the wake of the Moody's downgrade, which, as you know, blames successive administrations, but also Congress for a ballooning budget deficit, Moody's says shows little signs of narrowing, it's unclear if they really will get those aggressive cuts that they're looking for. In fact, I caught up with Congressman Chip Roy of Texas on a one-on-one basis on Friday before the budget vote was delayed. And he told me that they're really pushing for the immediate implementation of these work requirements, which is considered to be a pretty ambitious timeline, not to mention it would face scrutiny in the Senate and put the White House in a politically fraught decision. John, the other one that we're still waiting, the other sticking point that we're still waiting for details on, of course, is lifting the SALT cap, which just adds to the conversation about those revenue raisers.
I'm glad you mentioned Chip Roy, because not only he's on the Budget Committee and he voted present to allow this bill to go through, but he's on the Rules Committee, so he's going to be at the next round of infighting. And Tyler, overnight, he said the bill does not yet meet the moment. What else does Chip Roy, Ralph Norman, what do they want to see?
Right. Well, they definitely want to see speeding up when it comes to those work requirements being implemented. They say immediately. Right now, they're currently in place to go into effect in 2029. We're hearing that likely there would be a compromise closer to 2027. The other thing, too, though, is trying to cut those deficits down even greater, find more revenue raisers when it comes to the tax side of the bill. Perhaps that could mean lifting the tax rate on some. The House Freedom Caucus has signaled its openness to a millionaire's tax, and we actually saw Nick Lowe of the SALT caucus over the weekend float that potentially they could let the top's tax rate expire under the 2017 tax bill, which would snap back that rate from 37% to 39.6%. So perhaps we could see some sort of compromise there. And then lastly, Annmarie, importantly, is really those clean energy tax credits. The House Freedom Caucus wants to see those rolled back immediately. That's something else that will face pushback in the Senate from those Republicans in representing those states that are trying to transition their economies.
Tyler Kendall with the latest. Tyler, thank you. More from Tyler in the next hour. Let's extend the conversation with Jeannette Lowe of Strategas, a bad company. Jeannette, welcome to the programme. Two events, one event, one outcome. Let's talk about the event. The US losing its final AAA credit rating, this one from Moody's, and the outcome, Treasury yields back through 5% on a 30-year bond. Did the fiscal hawks in Washington just get some extra fuel?
Oh, absolutely. This was definitely something that bolsters their argument. They had gone into this fight all along saying there needed to be much more significant budget cuts. They were the ones who were pushing for even larger budget cuts in order to have larger tax cuts in place. And they're still not satisfied with just overall where the fiscal situation is. Essentially, they're looking at the federal spending levels and seeing that it's essentially about still 4 percentage points higher than it was pre-COVID in our long-term average. And so that's something that they really want to tackle here. So the fact that you had on Friday morning, the members of the House Budget Committee, the fiscal hawks on that committee, voting no against this bill to send a signal that they wanted more significant cuts. They wanted to accelerate them. And then on top of that, you get the Moody's downgrade in the afternoon. And that really added some fuel to their argument to say that we need to do something even stronger because of the U.S. fiscal situation.
Did this upend Speaker Johnson's plan to get this all done by Memorial Day?
I don't think so. I think that there is obviously some significant push here to get this done. This is part of Trump's agenda. He does want this bill to get accomplished. There has to be some compromises because obviously the fiscal conservatives do not have a solid majority. They have to negotiate with the moderates to run this through on a Republican-only basis. And failure means that if you would actually have to do a compromise with Democrats towards the end of the year, if you can't get it done through reconciliation, and that means that you would probably have higher spending levels and higher taxes, and that's something that the conservatives don't want.
Well, to you and Jonathan's point, the fiscal hawks seem to have some fuel right now after what happened with the Moody's downgrade. Who else has leverage in this fight?
Yeah, so I mean, obviously, I think the moderates do still have leverage because they are not going to vote for things that are going to cost them their seats. They are obviously the majority makers in this Congress. So that's going to be really important for them to not have significantly drastic cuts. So that's why I think, having work requirements moved up to 2027 rather than immediately makes a little bit more sense. You also do have the SALT caucus. So the blue state Republicans who are pushing for a higher SALT deduction, they believe that that's really important. So they're still going to be pushing to get their leverage in here. And then obviously we do need to watch the Senate as well. The Senate is saying that they're signaling that they're not happy with some of the provisions that the House has put forward. But the House also does have, and the Senate does have to realize that the House has this very slim majority. There's not a lot of wiggle room to really make significant changes if you have to deal with these competing factions in the House caucus.
Jeannette, I love a good deficit debate. It's a great thing to have. We discuss it all the time. Is there enough discussion about the growth side of this bill, how much it actually does boost growth and the other side of the balance sheet that's crucial to keep the deficit in some sort of balance relative to GDP?
Yeah, and I think this is a really important piece with the tax bill is we have two things that are happening. First, they did include more pro-growth tax provisions in this bill. So they have immediate expensing for CapEx, for R&D, and for structures, again, to kind of get more domestic manufacturing in the United States in the midst of this tariff war that we're essentially having. And at the same time, too, the fact that we had the significant tariff reduction on Chinese goods over the past week. So that also plays into this. So now we can have a tax bill that has more pro-growth provisions in it that can actually help to sterilize the tariffs that are still in place. And that's important because we do have essentially a $2 trillion consumption tax that's put into this economy. So having fiscal stimulus for consumers that will hit next tax season is important. Plus, you have these business investment incentives. And together, we look at what we have as the current bill in front of us. We're looking at saying that that is going to increase or boost a GDP by 1%. And that is a really important point to also keep in mind.
How much does that offset the increases to the deficit on a sort of relative basis at a time where people are saying at the same time growth is going to slow as a result of some of these tariffs?
Yeah, I mean, so I think we still think that the deficit is on a improving trajectory. You do have tariff income coming into the U.S. Treasury that won't obviously count for this tax bill, but we are going to see some improvement in the deficit. Obviously, it's not significant for especially fiscal conservatives, and so that's something that comes into play. But if we were looking at the fact that maybe we would have significant tariffs in place and maybe this tax bill would have been delayed, that wouldn't have helped to boost the U.S. economy and could have been a worse situation. If you actually have some of these pro-growth tax policies in place and they happen before the stronger tariffs hit, that actually provides some boost to the U.S. economy and then actually can help with the growth over the long term and then help with the deficit.
Jeannette, just finally, just to wrap it up, do you think they get this done a week today?
I do. I do think that they will get this deadline is very strong in the House. Now, maybe it's not done by Thursday, maybe it's done by Friday, or it gets pushed into that holiday weekend. But I do think there's a strong effort to get this done. And the fact that you had the Budget Committee meeting at 10 o'clock at night on a Sunday is really important to show that they really do want to get momentum. Voting present, obviously, was them backing down to some extent to allow the bill to move forward. And now they have a couple of days before they do that 1 a.m. Rules Committee meeting on Wednesday.
Jeannette, appreciate your time. Thank you. Jeannette Lowe there of Strategas, a bad company. The president back in Washington, D.C., and the president's going to be pretty loud, I imagine, this week on this issue.
He already is. He's on the way back from the Middle East to the United States, was saying stop grandstanding and get this done. Also, Child's Play, 10 p.m. meeting on a Sunday. The Committee on Rules will meet Wednesday at 1 a.m. They are dedicated to try to get the Memorial Day deadline. But that's the House. Wait till this goes to the Senate. This is going to be incredibly challenging to pass.
Lisa mentioned the growth picture. Lisa, I think you're dead on. This is the problem they've got. If they don't extend the Tax Cut and Jobs Act, you're going to see the growth picture deteriorate pretty quickly.
This is not just something that austerity can necessarily solve. This is the difficulty that you can't cut your way to a fiscally responsible picture. You have to tweak things in a perfect way on both sides where you're not hampering growth so much that you cut off your income to not spite your face.
A difficult moment for lawmakers down in Washington, D.C. Just about made sense of that.
It didn't make sense.
Equity futures on the S&P. It's early. It's Monday morning. We're down 1.2%. We can't make sense of any of it. Up next on the programme, Andrew Bishop of Signum Global Advisors, head of a phone call between President Donald Trump and Russian President Vladimir Putin. 5-day winning streak on the S&P 500. We're snapping that this morning. On the S&P, we're negative by 1.2%. Moody's stripping the US of its final AAA credit rating. That's unleashing a move in the bond market. Check this out. Long end of the curve, yields higher by 7 basis points at 5.01%. I think it's also important to recognize that the tax bill is advancing down in Washington, D.C., and that's going to have a bigger impact on this bond market than anything Moody's has got to say. With yields up at the long end, in the FX market, this is the tell, and it's not a great tell. The dollar's weaker, the euro's stronger, and we're seeing this across G10. Euro dollar, Lisa, right now 112.78.
This is the wrong kind of fiscal mix all around, and it is fueling speculation that international central banks are moving away from the dollar on the margins as a reserve currency. You can have that debate until we turn blue in the face. It's just this kind of mix of asset pricing is not what you want to see, and is currently fueling a question about a mini sell America.
Yields are up in the US. They're also up in Germany. We talked about this 30 minutes ago. Also up in Japan. Gold's rallying. Gold is higher today by more than 1%, and that's been the story of this building, not just this year, but for a number of years.
Christine Lagarde can throw shade at the dollar and U.S. policies, but the reality is that European policies haven't attracted the same kind of confidence that people can really get behind for the euro to have the same sort of reserve currency status. And that's the reason why gold has been the preeminent hedge, whether it's inflation, whether it's dollar supremacy, or whether it's just, it looks nice.
Snap back to reality. 5% plus move on the S&P 500 last week. This morning, negative by more than 1.2% with 3 hours until that cash open. Your morning movers look like this with Danny Berger. Hey, Danny.
Hey, John. It's very clear where the pain is concentrated in individual stocks. It is Mag 7 that is under pressure this morning with the deficit concerns, the Moody's downgrade, bond yields back above 5% for the long end, Nvidia down nearly 3%, Tesla's down more than that. So again, it's those types of names. All of that overshadowing what Jensen Huang was doing early this morning. He was in Taiwan at Asia's biggest electronic forum, touting new technologies, trying to do more of an open source thing for Nvidia code. Even so, shares are down again, back below 3% this morning. To the upside this morning, Novavax is a vaccine maker, a really long delayed road for them it had been to get approval for their COVID vaccine. This still moving shares. They finally got that approval over the weekend. However, it is a more restrictive approval. Only folks over 65 or those with underlying conditions can get the COVID vaccine. Even so, those shares up 16.6%. Netflix, that is also declining this morning with the rest of tech, but it's getting a double whammy this morning. Not only the overall macro environment, but JPMorgan downgrading from overweight to neutral, saying they're still long-term bullish on the stock. It's just run up a lot, some 30%. They say all of that price reflects the bullish case for 2025, John.
Danny, thank you. Appreciate the update. More from Danny in the next hour. On our radar this morning, Moody's stripping the US of its top credit rating, citing growing budget deficits from successive administrations with little sign of easing. As President Trump's big, beautiful tax bill advances in Washington, passing through a key House committee after a weekend of negotiations, but facing more pushback as it barrels towards a vote by the full House.
So basically, at the time the Moody's is downgrading the United States, this is going to give really some momentum to the fiscal hawks that say not enough is being done to cut the deficit, especially as we have spending. And you look at some of the independent congressional budget groups that are saying this is going to cost about $4 trillion over the next decade. Lisa, you brought up this great stat I tweeted about this morning from the Wall Street Journal. I think it is the most important stat of the morning, and it has to do with our interest payments. U.S. interest payments are the second line item after Social Security, above defense, above veteran affairs, above everything else we pay out. That's because $1 out of the 7 the U.S. budget pays out is going towards what? Paying off our debt. And this is going to make it a lot more challenging.
Which is the reason why both they have to increase some sort of fiscal discipline while also increasing growth. I just look at this and look at the market response. And when you look at the commentary, people are kind of agreeing with Scott Bessent. They don't really give a ton of credence to 2011-style sell-off in markets. That said, it brings the debate forward about the fiscal health of the United States and really underscores just what's at stake with that bill.
I just don't think 2011 is particularly relevant. The backdrop was so different. You had the Eurozone debt crisis almost at its peak back in 2011. You had this demand for safe haven assets like treasuries. No one really cared what S&P thought about that. You wanted to buy treasuries, and that continued. This is closer to what we saw in August 2023. And the backdrop for that was a worry about too much spending, too many bonds coming to market. And this basically collided with a quarterly refunding announcement from then Treasury Secretary Janet Yellen, and they had to make a move. This has been building and building under the Biden administration. They managed to cover it up by issuing a load of T-bills, and now the bill's coming due. And the bill's coming due at precisely the wrong time, not just for the Republicans, but also for this country, because you need to extend TCJA, because if you don't, you're going to slam the brakes on economic growth.
You can't really cut that at the same time as trying to repair the fiscal trajectory. The U.S. deficit has been growing under every president. It's grown over under the former administration of President Trump. President Biden expanded it incredibly due to the pandemic, and currently we're looking at something of a deficit that is 6% or more than 6% of the GDP. Moody's was saying that he expects the federal deficit to reach nearly 9% of GDP by 2035. This is akin to many emerging markets, and this is something that isn't so easy to remedy, and this is the reason why there's some yippiness in bond markets.
And we see that yippiness this morning, back through 5% on a 30-year. We need to talk about this too. This is going to be part of a broader conversation as we get more earnings from retail America. President Trump telling Walmart to stop blaming price hikes on tariffs, saying the retail giant should, quote, eat the tariffs. Walmart promising it will keep prices low for as long as possible.
So Walmart on Thursday came out and they said even at these reduced levels announced this week, when it comes to China and the U.S. having this détente, we aren't able to absorb all the pressures. The Treasury Secretary, though, went on TV and said Walmart will be absorbing some of the tariffs, but some may get passed on to consumers. He also said he had this phone call with the CEO and said that he had to give the most draconian response because of SEC rules. So basically pouring cold water on what the CEO had said on Thursday, that this was going to be the end-all, the be-all, and how they're going to pass on the tariffs. One other thing Scott Besson said that was interesting. He really felt like he was meeting the American people where they are. I don't want to blame consumers after what happened during the Biden administration with high inflation. Basically, I understand why consumers feel this consternation and anxiety right now because they have the lived memory of very high inflation under the prior administration.
We'll come back to this conversation with Neil Dutta of Renaissance Macro a little bit later on in the program. He'll catch up with us about an hour from now. Need to catch up with this story. President Donald Trump holding a phone call with Russian President Vladimir Putin later this morning to try and reach a Ukraine ceasefire deal. Bloomberg's Ollie Crook joins us now for more. Ollie, what's the latest?
Yeah, Jonathan, we've been really waiting for the moment of truth in Ukraine ever since Trump took the presidency. We get one step closer to that today, potentially today at 10 a.m. Eastern time, 4 p.m. Central European time, when he speaks, President Donald Trump speaks with President Vladimir Putin in order to potentially thrash out the conditions to begin a ceasefire, to begin peace negotiations. Remember, this is something that the Europeans and Trump and Ukraine were pushing last week. It was rejected by Putin. Instead, they had those sort of mid-level talks in Turkey, which basically yielded nothing. And then Trump said, listen, nothing's going to happen till I talk to Putin. And today he will talk to Putin. All of the European leaders that I spoke to over the last few days in Albania at that leaders meeting that was hosted on Friday, they all say that this is basically the President Putin stalling for time because he's got initiative on the battlefield. This is not a serious overture. For the Trump administration, there is coming a point, and I don't know that we reach it today, but we're getting closer to it with every one of these interactions where the Trump administration and Donald Trump needs to decide and needs to say who the problem, the impediment to peace is. Is it Vladimir Putin? Is it Volodymyr Zelensky? Or is the problem too large for the administration basically to take on? And every time we get closer and every time we have one of these interactions, we get closer to answering that question. And that is the question that is before everybody here in Europe and Ukraine and around the world.
Are we closer to a deal or closer to more sanctions? Ollie with the latest. Ollie, looking forward to your reporting in the next 24 hours. Joining us now to build on this conversation, Andrew Bishop of Signum Global Advisors. Andrew, the US, the president, is going to have to talk to the Russian leader, and then he's going to have to talk to the Europeans. Which conversation do you think will be the hardest?
I think definitely the conversation with the Europeans is going to be hardest because it's essentially going to amount to President Trump forcing the Europeans, or at least trying to force the Europeans to agree to President Putin's conditions for a ceasefire. And the main, or let's say most thorny one of those, is going to be a halt to all European weapons supplies to Ukraine during the period of that temporary ceasefire. That's going to be very hard for the Europeans to agree to. At the same time, Trump is going to put enormous pressure on them. And we've seen the Europeans back down quite dramatically over the past several months in terms of how much support and how much they're willing to stand up for Ukraine in terms of actions rather than words.
We have reporting that Putin is pretty confident that his forces can break through Ukraine's defenses by the end of the year. So do you think there's any matter in which Putin decides that he wants to have a ceasefire this year?
That's a very good question. So I think for the first 4 or 5 months of the year or of the second Trump administration, the difference between the odds of a ceasefire and the odds of a peace deal was minimal because essentially Putin wanted neither. Because Trump is running out of patience, we're now reaching a point where the odds of the ceasefire are good. The odds of the end of the war are very, very low still for the reason you just mentioned. And so the answer to your question, in my view, is yes, we are going to get a conditional temporary ceasefire. No, that is not going to lead to an end to the war, given Putin's sort of leverage still.
Andrew, I just got back from traveling with the president. Every single day, he left the door open. This was a lingering discussion whether or not he would peel off his Middle East trip and go maybe sit down with the Russian leader in Istanbul. Do you think Trump has shown his cards? He's too eager to speak to Putin?
Absolutely. Now, there's no question. And this is one of the reasons why I still do not expect an end to the war this year or anytime soon, frankly, because Putin has the upper hand. That being said, President Putin has shown that he's very, very good at, even though he has the upper hand over Trump, staying just one step ahead of Trump in terms of giving President Trump little carrots. And I think that next little carrot to avoid sanctions, to avoid Trump walking away from the table, is going to be a 2-3 week ceasefire.
Andrew, you keep talking about leverage over President Trump, leverage over Ukraine, leverage over Europe. I'm just wondering how much Putin loses that leverage if sanctions and secondary sanctions go on in a significant way.
He would lose it altogether. If meaningful U.S. secondary sanctions on Russian oil were to snap on, Putin would have to end the war within months. There's no question. It is exceedingly unlikely that President Trump is going to take that step.
How much did you view the meeting in Rome as a real positive between the vice president and Volodymyr Zelensky over the weekend? This sense that maybe the U.S. was moving closer to Ukraine. Do you think that that's just sort of cosmetic, or do you think that there is some substantial change in policy?
No, I think that is cosmetic, unfortunately. Yeah.
Well, it was certainly welcome because it was a massive difference to what we saw in the Oval Office, Lisa, a number of months back.
Yeah, I found that notable, given the fact that the two of them ended up in a screaming match. I just wonder what the sort of post facto analysis of that meeting was, whether there was a real sense that it failed on all fronts and why it failed, or whether there was a sense of that chastened the discussion in some sort of way. But it seems like there's been a real change.
The photo says it all, of J.D. Vance sitting next to Volodymyr Zelensky in Rome, and they're both smiling and laughing. It is very different than the tone that was in the Oval Office. So even if it's cosmetic, they are projecting a more united front as the president is heading into this 10 a.m. phone call with Putin.
Andrew Bishop of Signum Global Advisors. Andrew, thank you, sir. Looking forward to that call later on this morning and the outcome of it. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. We start with Moody's stripping the U.S. government of its top credit rating. The agency lowered the U.S. by one level from AAA to AA1 on Friday. Moody's cited the failure by successive administrations to deal with rising U.S. debt and deficits. Treasury Secretary Scott downplayed concerns over the downgrade, saying Moody's is a lagging indicator. Meanwhile, a Mexican Navy ship crashed into the Brooklyn Bridge Saturday night. 2 sailors were killed and 22 more were injured, 11 critically, when the ship lost power and scraped the bottom of the bridge. The Department of Transportation said there was no major damage to the Brooklyn Bridge. And the New Jersey Transit strike is over, but train service won't resume immediately. The Brotherhood of Locomotive Engineers and Trainmen approved a deal Sunday night to end New Jersey's first rail strike in 40 years. But rail operations are not set to resume until tomorrow. As for today, New Jersey Transit encouraged commuters to work from home if possible, which we know Lisa also endorses. That's your Bloomberg Brief. John?
Apparently, that's where Lisa wants them to stay. At home, Yahara. Yahara, thank you.
I am actually looking out for them. I am actually quietly jealous of them.
Are you supporting work from home?
I'm supporting a day of a reprieve. I'm not going against some of the return to work. This isn't a big political discussion.
It's not about having fewer people in New York.
This is not about long term. This is enjoy your day. Have a nice time.
Got it.
Go for a walk with your kids.
I'm not a big fan of work from home.
Do you want to fight about it?
No, I'm good. Right, I'm good. This is
no, I'm a big fan of congestion.
Okay. Up next on the programme, Sell America making a comeback.
I think that Moody's is a lagging indicator. I think that's what everyone thinks of credit agencies. We didn't get here in the past 100 days. It's the Biden administration. We are determined to bring the spending down and grow the economy.
Bond yields are higher, the dollar's weaker. Up next, Mark McCormick of TD Securities, live from New York City. You're watching Bloomberg TV. Moody's downgrading the United States going into the weekend, and here's some of the fallout. Equity futures negative by a little more than 1% on the S&P 500, down by 1.5 on the Nasdaq 100, following a stellar rally just last week. We snapped that winning streak on the S&P, 5 consecutive days of gains. In the bond market, yields are higher. The 30-year back through 5% for the first time since April, 5.02% on a 30-year. And in the FX market, the dollar weaker. Euro-dollar up to 112.74. Under surveillance this morning, Sell America making a comeback.
I think that Moody's is a lagging indicator. I think that's what everyone thinks of credit agencies. We didn't get here in the past 100 days. It's the Biden administration and the spending that we have seen over the past 4 years. And we are determined to bring the spending down and grow the economy.
So here's the latest this morning. The White House pushing back after Moody's stripped the U.S. of its top credit rating, sending the dollar lower and bond yields higher. Mark McCormick of TD Securities writing the dollar has a long way to go to get back to longer-term fair value. This downturn is likely just getting started. Mark joins us now for more. Mark, good morning and welcome to New York. It's good to see you.
Thank you.
Let's get to the SFX story. We asked this question last week. I'm going to repeat the question to you to get your response. Right. Fiscal stimulus leads to a stronger currency. Fiscal recklessness leads to a weaker one. What is this?
This is the latter. We've already seen this playbook. It looks like an emerging market. What happens is yields go up, currency goes down, equities fall. This is not what we're used to. This is not what you see in the U.S. But essentially, I think one of the things is the balance of payments in net international investment position shows that the kindness of strangers have been basically funding U.S. twin deficits. That is now a challenge. There's a trust problem. There's an uncertainty problem. There's a growth problem. And there's also a valuation problem. So what's happening very clearly in FX, and people have talked about this for a decade, the dollar's been overvalued. The dollar's been basically overvalued except for a little period of time for 40 years. But this is the catalyst. The catalyst is the rest of the world now has other places to invest. They're stimulating their economies. Their equity markets are essentially undervalued. And I think a critical thing here is what we're doing is we're unwinding globalization. And what we're doing is the U.S. was the spender, Europe and Asia were the savers. The savers are bringing their money home, and that leads to local higher rates, more consumption, stronger currencies, and higher equity markets. That's where this is going.
We've seen EM-type frameworks grip DMs before, but it's been temporary. Seen it in the UK, seen it in France, seen it in the southern European countries at times as well. How sustainable do you think this market regime actually is?
Well, I think it's a total regime change. And again, I think a big piece of it is what is Trump trying to do? That's every client meeting is, what are they doing? Are they trying to eliminate the trade deficit? Are they trying to generate revenue to pay down government stimulus? Again, what was Doge? If you look at these numbers, revenues in Doge is a couple $100 billion. The budget that's being announced right now, or the idea around it, we're talking about trillions. So this is not a revenue generating type of environment. So I think the piece of it is they want to eliminate the trade deficit. If they want to eliminate the trade deficit, yes, getting the dollar lower is a precondition, and that's how you could reindustrialize. But there's so many other pieces that comes with reindustrialization. It has nothing to do with the currency in terms of labor, infrastructure, all those kinds of things. But if the goal here is to reverse globalization, U.S. equities and the U.S. dollar are the centerpiece of globalization. And they've been essentially what you're going to do is you're going to eliminate their role within this, and you're going to give the renminbi, and you're going to give other currencies. And this goes back to that multipolar world. You're going to have a multipolar currency world, which gold is the anchor to bring it together.
So this raises a question, just to build on what John was asking. We've been talking about how close we are to a Liz Truss moment, where suddenly there's a real gut check in markets of policies. Is that the right way of looking at this? Do you see something like that on the horizon?
Yeah, so I think we already went through Liz Truss moment point 1 in April, like Liberation Day, the impact of that was a Truss moment. We pulled back. You could see that China basically stepped up instantaneously and was like, we're gonna match you on tariffs. We're not gonna back down. And now what you've seen is there's already been a walk back a little bit. but we are going to go through probably many trust moments. This is probably another mini earthquake version of this with the downgrade. Because again, what the market sees is the U.S. is in a very precarious position where the dollar's reserve status is being undermined at a time when it requires foreign investment. So to say to the rest of the world, we don't need you, we don't want your money, we don't want your capital, we want to be on our own, is saying to the rest of the world to return your currencies home and essentially find a way to grow your own economy. And this, what's happening is we're also seeing it in the pension fund world. The largest holder of U.S. equities is Canada, but there's also Japan's in there, Sweden's in there, Ireland's in there, UK's in there. All these countries own U.S. assets that they're going to bring back home and use and basically stimulate their own economies. And so this is going to pull money out of the U.S.
Can you give us a map to understand what this might look like in terms of mini Liz Truss moments? I mean, what's the magnitude of moves that we're talking about that could potentially cause these tremors, but not necessarily a wholesale change?
Well, I think a piece of it, right, the intuition around what should be happening is the economy slowing. The trade wars have pulled back a little bit. The markets have downgraded how many Fed cuts they're going to expect this year. But what's happening is rates are selling off. The curve is steepening. That's a sign of a loss of credibility. That's a lack of trust in the U.S. market. And what's happening is the dollar is declining. The curve is steepening. So I think one thing you want to keep on the radar screen is the U.S. dollar correlated to rates. It is not. That is a very, very concerning sign because what you would expect is as rates go up, you're still going to have to pay carry to sell the dollar. And you don't want to have those wide interest rate differentials and pay the difference on it. But the point is as long as rates are going up and the dollar selling off and those correlations are starting to change, that shows you that the regime is changing. The other thing is that U.S. equities are up. They've been rallying since Liberation Day, but the dollar's still not responding to higher U.S. equities. So I think a lot of it is what's happening in the equity market. If you track portfolios of hedge funds in the U.S. are buying into risk assets, but global funds are not. And you can see macro hedge funds are underperforming like localized hedge funds as a function of if they are negatively biased against the U.S. dollar, U.S. assets. And I think that the playbook is to watch how these correlations are not going back to normal. That'll be the key.
Mark, what do you make when the Treasury Secretary continues to reiterate that the U.S. still has a strong dollar policy?
I think he just has to say that. That is the standard litmus test. That is, they can't say that we would it's clear within certain frameworks and papers, the goal was to have a stronger dollar
so
to introduce
service.
That's every Treasury Secretary talks about a strong dollar. I've never heard anyone in the last 30, 40 years say we want a weaker dollar, but it's like, don't tell me, show me. And the behavior that's coming out. And again, the big piece of it, and I think everyone knows, is U.S. can't run twin deficits without foreign capital. And again, the Japanese are the largest owner of U.S. treasuries. And again, you're talking, and if you see the trade discussions going on with U.S. and Japan, Japan has a very big card they could play there, which is essentially undermining the treasury market and causing a further steepening of the curve.
The U.S. wants that capital. I want to be very clear about that. What they don't want is their exports. Can you have one without the other?
You can't. You have, essentially, there is an accounting identity that works, and it's worked through the entire phase of globalization. And the phase of globalization since China entered WTO is essentially U.S. runs a deficit and the rest of the market funds it by buying U.S. assets. So you run the twin deficit, you run a current account. The other side of the ledger is a capital account. That's all the foreign money coming in. So the reason why the dollar's overvalued by 15, 20% on a broad basis is everyone has been buying U.S. equities since even the last 5 years. It is the largest holding of assets. If you look at foreign holding relative to U.S. market cap, it's almost a third. So essentially, the U.S. equity market's been the only game in town, especially for the 10 years that we had or 15 years of low interest rates. And essentially, you cannot have those two things work together. You need foreigners. And essentially, if you wanted to reindustrialize, you would need the foreign capital to fund the factories and to fund the deficits and to bring the engineers. You would need all that to work.
That's the structural bid in dollar assets. Will we upend that? Mark, it's good to see you, sir. Appreciate your time. Mark McCormick there of TD Securities, a clinic on the FX market. The second hour of Bloomberg Surveillance, just around the corner.
Have mixed data throughout this period. We're not going to really know where we stand.
The consumer is much more sensitive. What we've seen and heard has allowed us to take down our recession fears just a little bit.
What we're seeing collectively in all this data is an economy that looks to be slowing a bit.
The hard data are going to turn. When the hard data turn, we'll have the Fed cutting.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning. Good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. And your scores look like this. Equity futures on the S&P negative, and we're down across the board following a 5-day winning streak. We break that this morning. The S&P down by more than 1%. Lisa used to talk about a so-called toxic brew. This is what a toxic mix looks like. Equities down, bond yields higher. Check out the 30-year. Back through 5%, yields up 8 basis points at the long end, and the dollar weaker. Euro dollar advancing by some 1 percentage point this morning. Euro dollar at 112.76. That's the toxic mix that we saw back in April. We see it again this morning.
If you want to be optimistic, you could say this toxic brew follows this Nirvana sell-in last week when we saw an incredible rip-roaring rally in equities and bonds. That said, it is a toxic brew when you look at some of the fiscal overhang and when you look at some of the rhetoric coming out of Washington, D.C., not to mention some of the concerns about profit reductions among corporations, not most notably retailers set to report earnings. It is a difficult time to get your handle around U.S. policy, and as a result, a lot of foreign investors clearly are selling U.S. assets.
The Moody's downgrade is not news for many people in this market. It's been on negative watch for more than a year. We've arrived at a decision long after a lot of people had already made theirs. The budget deficit is north of 6% of GDP in this country. In good times, under successive administrations, we've got to do something about this. The question we keep returning to, what is the plan down in Washington as this big, beautiful tax bill advances?
Well, the plan is that they're going to spend more when it comes to this one big, beautiful bill. It passed a key committee last night. Now at 1 a.m. on Wednesday, it's going to go to the Rules Committee. Will it pass? Speaker Johnson has a very, very aggressive timetable. He wants this done by Memorial Day. Jeannette Lowe thinks they get there. But she also thinks the Moody's downgrade gives more impetus to these fiscal hawks to bring forward things like cutting in Medicare and also potentially getting rid of these green rebates and tax credits we saw under the Biden administration.
The size, shape, contours of this bill more important to this bond market than anything Moody's, S&P and Fitch have got to say about anything regarding the deficit in Washington.
There was a big sigh of what else is new over the weekend with respect to the Moody's downgrade. That said, it put a real spotlight on exactly what you're talking about. I'm having a hard time with the whipsaw, and you pointed this out last week, John, that we were talking about trade. The world is trade. Now it's all deficit. And we're not talking about trade. These things are intertwined. There is a question if you need the growth to offset the deficit, how you get that growth with some of the tariff rates that are on, and how those negotiations continue as that reality bites in Washington, D.C.
Which is why Terry Haynes thinks they actually get this bill done in July 4th. And that comes up to the date that there's this reprieve when it comes to reciprocal tariffs on Liberation Day. So getting everything done in July. Then this administration would be off to the races. It's so much more challenging in Congress. Barclays said this. They said they don't expect the Moody's downgrades to actually change votes in Congress, but could force selling of treasuries, which have much more bigger impact on Congress, which in the end kind of changes votes in Congress.
It just dials up the volume. Dials up the volume as we kick off a new trading week. And your trading week looks like this. Coming up a little bit later on this week, you're going to get numbers from Target and Home Depot at a time when the president is piling on the pressure on Walmart to absorb the costs associated with tariffs.
Yeah, but we haven't heard a public walkback of what Doug McMillon said on the call. And frankly, Scott Bessent took some real venom out of that. So if you wonder if Target and Home Depot reiterate some of the message that we heard from Walmart.
How much of a PR problem could this become further down the line? I hated it when the previous administration tried to blame inflation on Bidenflation, on greedflation and all those silly things. It was ridiculous. They came out with a massive fiscal package, shoved it through an economy that was supply constrained, and we got inflation. It had nothing to do with corporate greed. That was ridiculous. And this is too.
I couldn't agree with you more, which raises the question, do they actually succumb to that and hit it on their margins, or do they band together, or do they do what Tim Cook did, which is we're just going to have to raise prices independent of any policy changes. Prices are just going up, and maybe you're going to have to eat it.
Equities are down this morning. You've got to eat this. We're down 1% on the S&P 500. Yields are higher. This dollar is weaker. Coming up this hour, Jack Manley of JPMorgan with the U.S. stripped of its AAA credit rating. Kathy Jones of Charles Schwab as 30-year bond yields break back through 5%, and Dutta of Renmark as President Trump tells Walmart to eat the tariffs. We begin this hour with stocks lower and bond yields higher. Jack Manley of JPMorgan Asset Management writing, I don't think we are out of the woods just yet. There's a lot more policy uncertainty, which will translate into more macro uncertainty, which will translate into more rate uncertainty, which will translate into more volatility. Jack joins us now for more. Jack, good morning.
Good morning.
Is the worst behind us?
I think the worst is behind us, but I don't think the coast is clear just yet, John. I mean, there's a lot clearly going on underneath the surface at the moment. Headlines every day that seem to fine-tune the output of any sort of model that you may have. And I always like to remind people when I'm having conversations with our clients that trade and tariffs, that's what's been dominating headlines at the moment. Now we're getting, of course, some discussion around the fiscal side of things. That downgrade over the weekend helps to accelerate or emphasize that discussion. There are also significant changes to the regulatory environment coming down the pipeline. There are significant changes to immigration that are happening and evolving and will continue to get more impactful. We're in the early innings of this ball game. There's a lot more time until midterms. There's a lot more time until the presidential election. And when you're talking about years in Washington, that's essentially an eternity. There's a lot that can happen. And so, I think, yes, peak trade tariff enthusiasm in Washington, that is probably behind us. Does it mean the market's just up and to the right from here until the end of the year? I don't think so.
Let's pick out one security, one number. 30-year bond yield, 5%. Two questions. How much does that constrain Republicans in Washington? How much does it constrain this equity market?
I think it constrains policymakers a lot more than it constrains markets. I think of this as somebody as, I'm a relatively young guy. I'm living in the city. I'm not on the property ladder right now. And with Treasury yields where they are at the moment, especially the further you get along the curve, the harder it is to get on that property ladder. And as we know, owning property is a quintessential part of the American dream of how you define something like that. And this administration is going to lean very, very hard, and we see it on the pressure on central bankers, on Jay Powell in particular, to move rates lower. You mentioned, Lisa, we of course need a little bit of growth to help to offset whatever's going on with deficits. We also need lower interest rates to help to inspire some of that growth. It's very hard to grow when you have long yields that are as high as they are right now. And I do think that's going to force policymakers to rein in some of these fiscal discussions. On the equity side of things, though, we're kind of back to where we were, last year and the year before, which is that the rally that we've seen since Lowe's earlier this year has been driven overwhelmingly by those magnificent 7 names. They're up on long-term secular trends like technology, microchips, artificial intelligence, obviously, in particular. And if you are talking about a 5, 10, 15-year long-term secular trend evolution revolution, then 5% on the 30-year is not going to make much of a difference. Maybe for those smaller companies, maybe for those companies that are more sensitive to rates. But those Magnificent 7, they're relatively insulated.
I'm struck by the fact that maybe models have changed. The parameters, at least for these models, have changed. Torsten Slok put out a deck this morning talking about how there's declining foreign participation in 30-year Treasury auctions. And that relates to U.S. equities as well. What we heard from Mark McCormick is that pension funds around the world, particularly in Scandinavia, in Canada, have really been selling U.S. assets. There is an anger and there is a look for something else that has potential better growth opportunity. Isn't it a structural change that removes some of the dynamism, some of the underlying momentum in U.S. equities in addition to bonds?
There have been sell America sort of periods or periods of enthusiasm around selling America in the past, and all it takes is time to get over that. I think at some point, we have clear evidence, I would say, that there is room for negotiation, that these trade hostilities could lower, which in theory could make us all a little bit friendlier, over the next couple of months, couple of years. But I also think it's very hard as a global investor, regardless of your sentiment around the United States and the administration and current policy, it's very hard to ignore some of these companies that are out there that are doing the bulk of the heavy lifting in global equity markets. And I think when push comes to shove, a lot of these pension funds will have mandates to maximize returns for their participants. A lot of individuals saving for retirement on the private side of things are going to be looking for those meaty gains. And it's going to be really hard to get that outside of the States.
So you don't think that there's a structural change that moves any kind of outperformance away from the U.S. elsewhere?
No, that's the question I've been hearing constantly, Lisa, is how do we think about, the next 15 years? Have we abandoned this previous regime? And I have to say, no, I don't think that's the case. When I look at what's going on with foreign markets, in particular in the developed world, I like to think about things thematically, and I like to think about things thematically overseas, because valuations, which are always like the biggest reason why everybody wants to invest in foreign markets, clearly don't make much of a difference in and of themselves. You need something, you need some sort of catalyst, you need some sort of theme. And when I think about the themes that are taking over foreign markets, international developed market banks have done extraordinarily well over these past few months. European aerospace and defense companies have done extraordinarily well over these past few months. I mean, real, meaningful outperformance underpinning that sort of higher level outperformance of these ex-US markets relative to the States, the biggest outperformance that we've seen in decades. But European banks are doing well not because they're innovating, but because interest rates aren't negative anymore. And you can't make money if you're a bank when rates are negative. And now rates aren't negative. And is there a structural shift there? Will the ECB never go back to negative interest rates? Yes, that's probably true. But it's not like we can expect 20% returns out of European banks every year for the next 15 years. European aerospace and defense, I think it's actually a very similar story. There's a lot of pent-up demand here, with Europe not having spent a whole lot on its collective defense over these past couple of decades, now being forced to pony up a little bit more cash on that front. But at the end of the day, these are industrial companies. You're not looking for 15, 20% out of these names over the next 10 to 15 years. So this, to me, feels like a tactical story, and it's got legs. It's interesting, and these underlying shifts are real. But it feels like we've just sort of rebased ourselves higher in these markets, as opposed to unlocking some sort of new, secular trend or shift. I think tech is still where it's at, and I know that right here is the best place to do that.
What are you telling clients to do?
What am I telling clients to do? I like bonds right now. I like shorter duration fixed income.
So I can't sell you a 30-year with a 5% yield?
No, I don't think so, my friend.
Okay.
I'm sorry. I'm sorry. I don't want to touch any of those. And you know what?
I've got a 30-year.
That's been sort of the story for a long time, though. And I do think it's very interesting. We talk about this downgrade over the weekend. Stocks and bonds are back to moving in the same direction, because stocks and bonds move in opposite directions really only when you're looking at growth shocks. And what's driving rate markets right now is not growth shocks or growth risk. I mean, a lot of that recession risk is off the table given the trade deal. Now it's concerns around fiscal discipline, about this ballooning budget deficit. And when rates are moving up in response to those things, it's bad for stocks, it's bad for bonds. So I don't want to be very long duration, but I do like fixed income for its ability to protect against a growth shock, because as we talked about earlier, we're not out of the woods just yet. There could be a recession on the horizon. And then on the stock side of things, it's boring, but I like U.S. assets. I mean, maybe I like foreign markets more than I have in a long time, but I still overweight U.S. assets. I certainly like large cap companies, and I'm frankly kind of indifferent between the growth and value split, because you're just looking at a big old index that's going to have a lot of growth and a lot of value in it.
To your point, these aren't growth shocks, they're policy shocks. Yeah. And stocks and bonds continue to trade in lockstep. A 30-year yield higher by close to 8 basis points. The yield now 5.02%. Your colleague, remember this, Priya Misra, JPMorgan, 30-year. It's a risk asset I don't want to touch.
I heard that all morning in my head. I was thinking, she just nailed it. And that's the reason why everybody says we're bullish on bonds, the belly of the curve. Maybe out to 7, maybe out to 10, but 30-year, absolutely not.
We'll see if we can sell Jack a 5-year later in the programme. Jack Manley of JPMorgan Asset Management is going to be sticking with us. Yields are up across the curve, but much more so at the long end of the curve. The 30-year, 5.02%. With an update on stories elsewhere this morning, let's cross over to Yahara Anand for your Bloomberg Brief. Hey, Yahara.
Hi, John. NVIDIA CEO Jensen Huang is everywhere. He unveiled new products, including faster chip systems and software in Taiwan earlier today. He introduced updates to the ecosystem around NVIDIA's accelerator chips, which are vital for developing and running AI systems. The goal is to broaden the reach of NVIDIA products and get more industries and countries to adopt AI. Meanwhile, Israel Prime Minister Benjamin Netanyahu said Israel will take over all of Gaza as the military announced it would carry out an unprecedented attack on Hamas. In addition, Israel will start allowing aid trucks into Gaza for the first time since March. Netanyahu said it needs to make sure there is no starvation crisis in the territory. And Morgan Stanley's chief U.S. equity strategist Mike Wilson says investors should buy any dip in U.S. stocks after Moody's downgraded U.S. debt. Wilson says he sees a greater chance of an equity pullback as 10-year yields move above 4.5% in reaction to the downgrade, but notes that his team would, quote, be buyers of such a dip. That's your Bloomberg Brief. John?
Yahara, thank you. Need Mike to define that dip. 1% move after a 5% plus rally in a single week. Does 1% get it done?
We can have him on and talk about that. Is this sort of the new threshold? He was also talking about 6,100. To get above that, you really have to have earnings per share upgrades, and you're not seeing that. So there are some other thresholds here. There are other things at play. So maybe the dip is maybe bigger.
Yeah, in the context of the rally off the April low, it's like
sure.
this big right now. We're down about 1% this morning. Up next, getting the tax bill over the line.
The plan is to move it to the Rules Committee by midweek and to the House floor by the end of the week, so we meet our original Memorial Day deadline. I think it's going to send a very important message of stability to the stock market and the bond markets.
Not much stability this morning. Up next on the program, Bloomberg's Tyler Kendall joins us live from the nation's capital. Live from New York City this morning. Good morning. Before we get into the losses this morning, think about the rally over the last week. 5% plus on the S&P, close to 7% on the Nasdaq 100. We snapped the winning streak. It looks like this morning. Here are the losses. We're down by more than 1% on the S&P. We're down by 1.5 on the Nasdaq 100. Under surveillance this morning, getting the tax bill over the line.
The plan is to move it to the Rules Committee by midweek and to the House floor by the end of the week, so we meet our original Memorial Day deadline. I think it's going to send a very important message of stability to the stock market and the bond markets, and as I mentioned, to job creators and entrepreneurs and risk takers. This will be the pro-growth economy that we have been waiting for and that the American people voted for. We're going to deliver on this, and we'll get everybody in line to do it.
So here's the latest this morning. The House Budget Committee approving President Trump's big, beautiful tax bill. 4 hardliners on the House Budget Committee voting present, allowing the bill to advance after securing a promise from party leaders to speed up Medicaid cuts. Joining us now from the nation's capital, Tyler Kendall. Tyler, let's go through the timeline and the potential obstacles still ahead of us.
Yeah, hey, John. Well, House Speaker Mike Johnson says that he still wants to get done the entire reconciliation package by Memorial Day. But to be sure, there are still some big hurdles that need to be clear. And while these fiscal hawks say that they have in writing from House leadership some of these planned changes, including speeding up work requirements being implemented for Medicaid and also rolling back those tax credits, those clean tax credits under the IRA, to be sure, the actual bill text has not yet been changed. So negotiations are ongoing. We are expecting those changes to be implemented come Wednesday when the bill goes in front of the Rules Committee. But even as fiscal hawks bolstered their argument to their colleagues, perhaps amid the Moody's downgrade, at this point, it really is uncertain whether or not they'll get the sort of aggressive changes that they are advocating for. I mentioned this last hour on this program, but I did have the chance to catch up with Congressman Chip Roy on Friday on a one-on-one basis before that vote was delayed. He's perhaps one of the most vocal members of the House Freedom Caucus, and he sits on the Rules Committee, which is where this legislation is headed next. And he told me that they are advocating for the immediate implementation of these Medicaid work requirements, considered to be pretty ambitious, not to mention that it will face pushback in the Senate and put the White House in a politically fraught position. Now, John, of course, the other big sticking point that we're looking for in order to get this deal all wrapped up by next Monday would be what happens when it comes to lifting that SALT cap. At this point, there hasn't been movement on a deal and, of course, raises more questions when it comes to revenue raisers.
Tyler, Terry Haynes of Pangea says that the One Big Beautiful Bill, he calls it 1B3, can pass by July 4th, become a law by July 4th. What are the hurdles potentially to get to that moment?
Well, we have to keep in mind, Annmarie, that there's a few issues by doing this as one big, beautiful bill, which is that, yes, Republicans do not have to negotiate with Democrats. They get to pursue this fast-track sort of route, but they do have to negotiate amongst themselves, not just within their own chamber, but also in the coordinating chamber. And once this bill gets to the Senate, things could really completely change. And Medicaid changes are really one of the big sticking points in the House version of this bill. But once it heads over to the Senate, we've already heard from some key Republicans, including Senator Josh Hawley, who says that he will not support anything that could limit somebody's access to those benefits. So that's going to be a really big sticking point that we watch going forward here, because keep in mind the Senate does have to get to work on this bill as well.
Tyler Kendall with the latest in Washington. Thank you. Jack Manley of JPMorgan Asset Management still with us. Jack, let's continue this conversation, but I want to talk about some of the economic data we've had so far. You mentioned consumer sentiment is rock bottom. Is that an economic survey or a political poll?
It feels like it's become a little bit more political, John. I mean, I look at consumer confidence numbers over the last several decades. I mean, we have data going back to at least the early 1970s, and I think it is stunning when you realize that confidence numbers in April are the second lowest they have ever been in history. We're talking about worse than dot-com bubble, worse than 9/11, worse than the financial crisis, worse than COVID. And the world doesn't feel that scary right now, especially given some of the headlines that we've gotten over these past couple of weeks. I mean, not amazing news, right? But is this truly the worst, or I guess the second worst things have ever been in the last half century? I think the answer to that is probably no. The risk with soft data is that they have the tendency to become hard data if they're left to their own devices for long enough, right? That sentiment persists for long enough, and then all of a sudden you might see these things realized, and that could be realized from a growth perspective. It could also be realized from an inflation perspective. Inflation expectations are about as high as they've been in several decades. But I really hope that the headlines, that trade deal about a week ago today, help to calm those individuals that might otherwise not be feeling so good. We see those numbers come up, and then soft data start to reflect the hard data reality that we've been looking at.
When it comes to the entire policy proposal and the tax bill, we've talked a lot, and analysts have talked about how extending TCJA was a removal of a headwind. But given the new concerns about the fiscal deficit, the Moody's downgrade, is it now actually putting a headwind back in play?
I think so. I mean, it's really complicated when you are dealing with such enormous numbers from a fiscal perspective. I mean, trillions that we run in deficits every year, and of course, any sort of tax cuts that we have, even without the incremental increase in SALT deductibility, even without the elimination of taxes on tips or Social Security benefits, we'll be adding trillions of dollars to this deficit. And when it comes to spending cuts, what I'm hearing right now, it really feels like you're picking up pennies in front of a steamroller. Like the biggest things that you can do to meaningfully move the needle from a spending perspective in Washington have to do with entitlement benefits. And it doesn't have to do necessarily with these work requirements, although I'm sure that would help. I mean, we need to fundamentally transform how Social Security works. I was a history major in college, so I always like to lean back on my history degree, and I always like to remind my clients that the Social Security Administration was introduced during the second Roosevelt administration, FDR administration in the 1930s, when most people didn't live much beyond retirement age. Like, the program was never designed to support you for 30 or 40 years. It's not the way that it's supposed to work. We need structural changes like that, and that kind of thing is certainly not in the cards right now, and it's certainly nothing that could get passed in the next week or couple of months. So I feel like we ultimately come back to this problem that, yes, we have an enormous amount of fiscal pressure right now on the government, but with the Treasury Secretary telling us that we shouldn't really care about that downgrade. And frankly, given the conversation we had earlier, maybe he's right. I mean, maybe this is something that's been baked in for a very long time.
Yeah.
I don't think it's going to meaningfully change the narrative.
Jack, you understand the problem. Lisa, the problem is the solutions we need. It's political suicide for many of the people down in Washington.
Which is the reason why it hasn't happened time and time again. At this point, there's some people saying maybe a 5-year, 30-year yield will be the pressure that they need for it not to be political suicide. We'll see. You ask about Mish, and the sort of political poll aspect of it. That still has import, because that also still does carry weight in Washington at a time where that clearly has been weighing on people's minds and has changed the conversation.
You need the pressure to come from the bond market.
Yes.
The question is 5% on a 30-year the pressure that's going to get it done?
It doesn't sound like it based on the rhetoric. But what level will it do? 5.5%? 6%? 7%?
Quick move to 6 might wake them up.
Yeah, that would wake them up. Like a fresh brew of coffee.
It might wake them up.
Yeah.
I just don't think it's 5. We're back to levels where we were in April.
And it hasn't been dramatic. That's also been really important. It hasn't been a seismic change that's really caused disruption.
Jack Manley at JPMorgan, thank you, sir.
Thank you.
We don't want a quick move to 6, just to be very clear about that. Up next, Kathy Jones at Charles Schwab as 30-year bond yields break through 5%. Live from New York City this morning. You're watching Bloomberg TV. 5-day winning streak on the S&P collides with some bad news for the US government. Equities are down by 1% on the S&P. On the Nasdaq, we're down by 1.5. I think you have to take a step back, though, zoom out and think about the rally we've seen off the lows of April. Huge rally, including a big run-up last week, 5% plus on the S&P, close to 7% on the Nasdaq. I know you're all interested in the bond market moves, so here they are, 2-year, 10-year, 30-year. 30-year yield higher now by some 8 basis points, 5.02% on a 30-year. And much has been said so far this morning about the accompanying dollar weakness we're seeing. And it's real. It's true. It's something we should be thinking about. Dollar weaker against everything in G10. But there's an additional point I think we need to make, and we tried to make it on Bloomberg Surveillance a few times already this morning. You're not seeing a bid into another haven asset. You're not seeing a bid into bunds. Yields are higher in Germany. They're up in the UK. They're higher in Japan as well. Yields are up around the world.
So this really calls into question this narrative that the U.S.'s pain is going to be Europe's gain or Japan's gain, because ultimately it's not that clear cut. There's something else going on where people don't like the U.S., but they don't know what to like, so they go to gold. And that has been a story for a long time, and that seems to be the similar story this morning as we try to parse out how much reality there is from fiction around the Sell America trade.
Bond yields are up, the dollar's weaker, gold is trading higher, up by 1% so far this morning. With 2 hours until the cash open, your morning movers look like this. With Danny Berger. Hey, Danny.
Hey, John. Well, in that equity market weakness, it is Mag 7 that is leading us lower. Tesla being the hardest hit with this more macro type concern. Shares are down nearly 4%. But to your point, John, it is important to note that this led the gains last week. Tesla was up some 17%. Mag 7 did really well last week, rising every single day. Even so, shares are down. Now, in other tech news, you also have Alibaba shares, the U.S. ADRs, falling this morning, those by about 2.3%. The New York Times out with the story over the weekend that the Trump administration is more closely scrutinizing a deal between Alibaba and Apple to use Baba's AI technology on Apple products in China. Bad news for Apple if they are scrutinizing it, considering they're already behind on their AI products. But according to the reports to the New York Times, the U.S. administration looking at adding Alibaba and other AI tech names to a list of companies that can't do business with U.S. companies. Finally, wrapping things up with Reddit, this getting a downgrade from Wells Fargo to overweight to equal weight. The issue, according to Wells Fargo, is that demand for different searches, and it's not going to be going to Reddit. It's going to go to places like Google AI, with more and more beefing up of that technology. So I guess instead of going to Reddit to look for answers, we're just going to listen to the robots on Google AI for any questions we have. So those shares down 6.2%, John.
That's the future, apparently. Danny, thank you. More from Danny later in the program. On our radar this morning, Moody's stripping the US of its last top credit rating, cutting it by 1 notch from AAA, reinforcing worries about the nation's fiscal outlook.
So the commentary has been similar to what we heard from Scott Bessent, which is essentially Moody's tends to be a lagging indicator. We already got a similar downgrade of the U.S. by S&P and Fitch. And of course, the U.S. has been on watch for downgrades since late last year or the year before even. So this isn't a huge surprise. That said, and Priya Misra, who came out with the 30-year being a risk asset, had this to say: this is a reminder that it is expensive to kick the fiscal can down the road. And right now, that fiscal can is getting kicked once again. And that's the reason why a lot of people are focused on Washington.
Moody's in their statement talked about the interest payment ratios. And right now, if you look at our budget, paying off our debt, those interest payments are second line items after Social Security. So it's bigger than defense, it's bigger than veteran affairs. And this is the issue you have when the bond market starts to push back at a time when they're trying to pass another, quote, big, beautiful bill.
Manish Singh at Crossbridge over in London put it nicely. This is yesterday's weather report. What matters is the policy that got us to this place, not the call from Moody's, Fitch or S&P. And the policy needs to course correct. Now, this is the bill that's going through in Washington that Annmarie's talking about. It is advancing. The House Budget Committee advancing the president's big, beautiful tax bill. Republican hardliners winning agreement from party leaders to speed up cuts to Medicaid coverage. But the fiscal hawks just got some fuel over the weekend.
They got some fuel. They voted present. They're advancing the bill. But 2 of those individuals are now on the next committee that's going to meet Wednesday, 1 o'clock in the morning. That committee needs to advance this bill in order for it to hit the floor and then to get to Johnson's Memorial Day weekend. We've passed the bill. No one really knows what's in the bill because they haven't actually written it down. It's all been verbal negotiations. But Jake Sherman at Punchbowl talks about the fact that there's a quicker phase out of clean energy tax credits, as well as an acceleration of the implementation of expanded Medicaid work requirements, which means the moderates are going to push back. So any leverage or concession Speaker gives to one faction, he then has another problem on the other side. And there's so many competing factions, and the numbers are just too slim.
I don't think that we're at the point where we walk into one of these meetings with Bloomberg Anywhere and hold up the 30-year bond yield of 5%. But I think the fiscal hawks are getting closer to that moment. Might not be 5, but we're getting closer.
What does fiscal hawk mean? I've been asking this question because everyone comes on and they say all the proposals aren't enough to get us even close to it. They're just sort of a pimple on, But there's this question going forward about what happens when you actually have to deal with entitlements, et cetera. Jack Manley was here basically running for office talking about how we have to reduce the age for Social Security. This is really the key question. Can they do anything that's politically palatable? And is there an understanding in the general public that this is something that has to get done, or do they have to see mortgage rates at 7% to do that?
Republicans would define it as for the cuts, against the spending. That's what they'd say.
Well, sure. At the same time, you can't cut your way to prosperity either. And this is a difficult moment.
For the tax cuts, I should say.
For the tax cuts,
Sorry.
yeah. For the tax cuts, yes. And that is part of the reason why you're seeing tax cuts on the business side, but also the idea of the salt taxes and what potentially can get done there. It's so confusing.
They're
this
the
sausage.
Extras.
Yeah,
There's
I know.
a lot of extras in there.
Yeah, but they're extras and they kind of have to happen. And I don't know. This is going to be a real fun one to watch.
Well, if they don't cap the salt tax, it goes the salt state and local tax deduction, then it goes to basically infinity. So they also need to do something if they want to rein in salt as well.
Yields are up by 8 basis points now, 30-year, 5.02%. Got to squeeze in this story as well. President Trump saying he will speak with the Russian leader at 10 a.m. about, quote, stopping the bloodbath in Ukraine. Sources telling us here at Bloomberg that Putin believes he has the upper hand as he looks to break through Ukraine's defenses by year end.
So this basically puts into question whether or not Putin's going to come on this phone call and offer any meaningful concessions. And then if he doesn't, he continues to slow walk it, then what's the administration response? There is a lot of chatter that potentially this administration at some point might be willing to double down and go harder when it comes to sanctions to try to force Putin to the table. This issue lingered over Trump's entire Middle East trip. Every single day, he teased out that he might go see Putin in person. That didn't happen, but they will have a phone call.
That phone call taking place 2 hours and about 23 minutes from now. So look out for that conversation. Let's turn to markets. Bond yields higher across the curve. The dollar weaker. Equities lower as Moody's strips the U.S. government of its top credit rating. Kathy Jones at Charles Schwab writing, this is not a case of the U.S. not having the capacity to pay the debt. It's the willingness to reduce the deficit that is the issue. Kathy joins us now for more. Kathy, welcome to the programme. Just your initial reaction to the news from Moody's over the weekend.
Yeah, it really wasn't a big surprise, as you indicated earlier. They had them on negative watch. They're following S&P and Fitch. As I watched the negotiations over the tax bill or the budget bill, I thought, oh, well, we're not getting anywhere. We need to go to get our house in order. So not a big surprise, but it does bring forward all the issues that you've been talking about, that we're not on a path to sustainability, something we need to address, but Congress doesn't seem willing to address.
I feel like every couple of years we talk about the bond vigilantes grabbing their pitchforks and getting ready to go out there and pick it. And it never actually has any staying power because other people say, actually, what you don't want, we love. How close are we to the bond vigilantes getting the upper hand and really shaping the narrative here?
Yeah, I've never been a big fan of the bond vigilante story because I remember the 80s and it was more about inflation than it was about the budget. But that being said, in 1985, we got sequestration, which actually did help get the budget back in order. How close are we? I don't think that we're looking at a stampede out of treasuries, but I do think that when you combine the whole policy mix we have, tariffs, a lower dollar that goes with that, and this sort of deglobalization trend, then you get a steady march higher in long-term yields because you're discouraging inflow of capital that we need. So I think that we just continue to see a steady climb in yields from here until something changes. Either the economy gets a lot weaker and we look at more Fed rate cuts, or we get some sort of, fiscal deal that actually makes sense.
Kathy, when it comes to a fiscal deal that actually makes sense, what are you talking about? Is there anything you see right now on the policy proposals?
Yeah, I mean, I'm not a policy analyst, but if I sat down with a spreadsheet today and said, how do I get back to 3% deficit relative to GDP, I wouldn't be cutting taxes on everybody, and I would, have to look hard at some of the spending that we're doing. But that's not what's going on. Now we're giving tax cuts and on top of tax cuts, and spending is maybe trimmed a little around the edges on Medicaid, but really all that does is on Medicaid, you're just going to limit access. They're already Medicaid spending to hospitals and to doctors is at a bare minimum level. So you're just limiting access to health care for part of the population. And yeah, maybe that gets you a little ways, but it's not going to turn the dial.
Kathy, in the grand scheme of things, we're having this conversation when things are good. The hard data's still okay. The hard data's still okay, and we were running budget deficits north of 6% through the previous administration when the economy was in expansion and GDP was running at 3%. Kathy, how much confidence do you have that if we do indeed go into an economic downturn, that this bond market rallies and yields fall?
Well, I think they'll fall just not as much as they would otherwise if we didn't have such a heavy debt load and we weren't pursuing these policies that are in conflict. Again, trying to get a weaker dollar, limiting trade, deglobalizing. All of that is going to be negative for getting the capital inflows we need to attract buyers of our bonds. So we can cut rates, but in line with slower growth and lower inflation, but they're not going to go back to levels that you might otherwise have thought.
Given that, Kathy, does that limit the argument for bonds, just as you talk to potential clients, as a counter-cyclical hedge the way that they have been traditionally?
Yeah, I was looking at the correlations between, say, equities and bonds over the weekend, and we had that big dislocation in April. Now we've gone back to a more normal correlation. I think we may see more of those dislocations. So what does that mean? Is bonds don't provide as good a hedge as they once did. But I think that it's going to be periodic dislocations rather than long-term dislocation, because eventually the policies will probably send the stock market lower and you'll need to be somewhere. And frankly, a 4.5% to 5% Treasury yield is not a bad place to sit. We've been just advocating staying shorter, benchmark a shorter duration and up in credit quality because we're not willing to take a lot of duration risk in this environment.
You're not alone, Kathy. That's for sure. Kathy Jones at Charles Schwab. That is the consensus position at the moment from pretty much everyone we speak to. They don't want to go out along the curve.
If you want to buy a 30-year bond, please call in and tell us why. Yeah, exactly. A 30-year leveraged 3 times bond. Let us know why, because ultimately it seems like there aren't that many takers out there.
Should we start doing phone-ins?
I think we should. I think that'd be really fun. Hi, I would love a 30-year.
I'd be way too scared of doing phone-ins. Who's going to screen them?
Yeah, they don't get screened. That would be a problem.
That's wild.
Yeah, well, maybe we could try that.
I'll take a pass on that. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. Shares of Alibaba are falling 2.2% in the pre-market following a report that the Trump administration raised concerns over a potential deal between Apple and the Chinese tech giant. The New York Times is reporting the Trump administration is scrutinizing a plan to make Alibaba's AI available on iPhones. Meanwhile, flights are being delayed or canceled at Paris's Orly Airport for a second day. It comes after air traffic control systems suffered a breakdown that caused significant disruptions yesterday. Airlines have been asked to reduce flights by 15% today, down from a 40% reduction on Sunday. And in sports, the NBA Conference Finals matchups are all set after the Oklahoma City Thunder blew out the Denver Nuggets in Game 7. They move on to face the Minnesota Timberwolves. That series begins tomorrow. Meanwhile, the New York Knicks are back in the Eastern Finals for the first time in 25 years. After beating the Boston Celtics, they'll be taking on the Indiana Pacers on Wednesday evening. That's your Bloomberg Brief. John?
Very cool. Yahara, thank you. More from Yahara in the next hour. Up next on the program, eating the tariffs.
Walmart is, in fact, going to, as you describe it, eat some of the tariffs. Walmart will be absorbing some of the tariffs. Some may get passed on to consumers.
Just how much? That conversation up next with Neil Dutta of Renmac, live from New York. This is Bloomberg. Here's a quick snapshot of the equity price action for you. Equities lower, but off session lows. We're down by 1.1% on the S&P, and the Nasdaq 100 we're lower by 1.5. Under surveillance this morning, eating the tariffs.
Walmart is, in fact, going to, as you describe it, eat some of the tariffs. On an earnings call, because of SEC requirements, they have to give the most draconian case. So Walmart will be absorbing some of the tariffs. Some may get passed on to consumers.
So here's the latest this morning. The White House putting the pressure on Walmart. The president writing over the weekend, quote, Walmart should stop trying to blame tariffs as the reason for raising prices. Eat the tariffs and not charge valued customers anything. Neil Dutta of Renmark joins us now for more. Neil, welcome to the programme. Lots to get through. Let's start here. We know by definition the importer pays the tariff. How are the costs shared? That's the question. How do you think the costs will be distributed in the months to come?
Well, I think the important thing here is the admission that obviously the exporter is not the one that's paying, right? I mean, that's an implicit subtext here. They're basically admitting that it's American companies and consumers that will end up eating the costs. So I think that's an important sort of admission by omission there. Look, I mean, I think some of it's going to get passed on to consumers, maybe half. I just, obviously retail profit margins aren't especially high to begin with. So I think it's going to be challenging for a company like Walmart to not pass on at least some of the tariff burden. But keep in mind that, the bigger issue is what that means down the line. I mean, if corporate profit margins get squeezed, ultimately they're going to have to pay the piper somehow. And meaning consumers, and that might show up in the form of weaker hiring, weaker wage growth. And that's another sort of effect on consumption in and of itself.
Hold on a second, Neil. This is actually a really important point. There's a question about how much some of these retailers can increase prices where it becomes not necessarily inflationary, but disinflationary because it suppresses demand. Are you seeing any evidence that that's actually happening, given that reports have been pretty mixed and dependent on just execution as much as anything else?
Well, I think companies are going to find significant resistance in terms of, trying to pass on the higher costs, because ultimately the inflationary story boils down to a household's budget constraint. And when you talk about tariffs, you think about price and quantity, whatever goes into P is ultimately going to come out of Q. And so, look, right now, nominal GDP growth is probably barely growing at 4.5%, if you can maybe talk me into that. So if you get a significant increase in inflation, you're going to get a big drop in real growth. I mean, it's as simple as that. So look, the household's budget constraint is getting worse, not better. And I think that, that ultimately means that, anything that's passed on to consumers will mean weaker real economic activity.
We've gotten a pretty big consumer stimulus over the past month. That's come in the form of significantly lower oil prices. And this is something that we've heard the administration talk about quite a bit. And I wonder how much that offsets some of the constraints on household budgets and actually allows more money for retailers, for goods, for things that might be more expensive due to the tariffs.
Well, we have seen a widening in spreads, right? So it's not like the drop in oil prices has translated sort of one for one to gasoline. So consumers haven't really felt the benefits. But no, look, at some level, I agree with you that, the drop in crude oil prices is meaningful. And the Fed should sort of take that into account when they think about how they're looking at interest rates policy setting, because you can't pick and choose which supply shock you want to pay attention to. On the one hand, you have a negative supply shock from tariffs. On the other hand, you have a positive supply shock from the energy markets. A typical rule of thumb, I believe, is a 20% drop in crude prices takes about 30 to 40 basis points off of headline inflation. So that'll, provide a meaningful sort of tailwind to the disinflation story. And remember, oil doesn't matter a lot for, underlying inflations, but it does matter for sort of the monthly swings in headline prices. So I think it's something to keep in mind here.
Neil, I want to get your take on what's going on in Congress. We have this big, beautiful bill slowly passing through the committees. Potentially it's going to hit the House floor by the end of the week. You've always talked about the fact that this is just basically baked into the market because it's an extension of TCJA. But now, potentially, does this become a risk for financial markets?
Well, I don't know. I always talk to you about what's going on in D.C. I don't really have many views on that myself.
We have a view on what it means for financial markets.
Well, I think basically what they're doing is removing a headwind, not putting in much tailwind. And so, Yeah, I mean, I don't think I guess my sense is that there's not much new coming from this. So if the bond market's keying off of the fiscal negotiations, it doesn't really make that much sense to me. So I do think a lot of that was already baked. And you're seeing, yields go up globally. So I don't really think it's U.S. fiscal that's driving what's going on in the back end of the Treasury curve here.
And Neil, what do you think it is then?
I just think that that's a good question. I mean, I think there's some residual sort of fading of recession risk. It's not just the U.S., right? I mean, it's also global in nature. I mean, you have a lot of countries kind of stepping up in terms of fiscal. It's not just the U.S. You have it in Europe as well. But I think it's it's a combination of economic resilience. People kind of getting tired of betting on a recession that hasn't happened. And, I think it's a sort of global fiscal story. So, the U.S. story, I think, by comparison to some of these other countries, there's not as much new there, I think, as is the case for some of these other countries.
We've been trying to sell 30-year treasuries to some people who've been coming on the show to see who wants to buy them. And so far, nobody has wanted to buy them, even those who believe in some of the resilience of the U.S. economic story. So are you one of those who sees this as an opportunity to invest in the dynamism of long-term interest rates?
To me, there are too many things in the economy that don't work with interest rates up at these levels. Therefore, interest rates will have to come down. So, yeah, I'd be buying duration here.
You think it's self-limiting, Neil? I think it's an important point. You believe it's self-limiting, that the laws of gravity still exist for the bond market?
Absolutely. How long can you sustain a situation where interest rates are running above the rate of nominal GDP? And as you know, my economic outlook is generally more on the cautious side of the consensus. So I think if economic momentum is slowing down, interest rates will come down as a result.
Neil Dutta. Neil, appreciate your thoughts as always, buddy. Neil Dutta there of Renmark on the bond market with yields back through 5% on 30s.
Yeah, he's a buyer. Well, he would be.
We found one.
We found one. His argument was actually something similar to what Jack Manley said, which is the self-limiting factor, that at a certain point it is not sustainable. Annmarie, to your point about $1 out of every 7 going to interest payments, at a certain point does it become sustainable for the U.S. government? That said, what's the mechanism to change that, right? Are they going to just buy bonds at the long end? I'm talking about the Federal Reserve. How do they bring it down if we don't have this sort of fiscal responsibility going on?
Interest on our debt is currently the fastest growing part of the U.S. budget. And it is the second line item after Social Security. It's bigger than defense spending. That is why this is also challenging at this moment for Congress.
Bond sell-offs are typically self-limiting. As Neil described them, yields go up, you slam the brakes on the economy, yields go back down again. But it assumes that yields fall in bad times. And I just wonder how much that logic is being tested at the moment.
Well, we aren't necessarily experiencing a negative growth shock, and that will be the reason why. If you do get a negative economic data print, it's going to be really important, not just with respect to gauging where the market's sort of gaming out the market, but to understand what the response is in bond markets.
The third hour of Bloomberg Surveillance is just around the corner. The lineup looks like this. Venu, Krishna of Barclays, Scot, Ciccarelli of Truist, Yelena, Schulyatyeva of the Conference Board, and Krishna, Memani of Lafayette College from New York City this morning. Good morning to you all. This is Bloomberg.
Markets have wanted tax cuts and markets want fiscal responsibility.
The market is laser focused on these negotiations.
So much uncertainty is built into the market.
This is going to be the most expensive bill in U.S. history. And so how are we going to offset?
If we get big deficit numbers coming out of this tax bill, I don't see how equity valuations hold here.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning. This is Bloomberg Surveillance, and the third hour of Bloomberg Surveillance starts right now. Your scores look like this. Equity futures on the S&P taking some heat out of the recent rally. We're down by 1% on the S&P 500. On the Nasdaq, we're down by 1.4. The toxic mix. Bond yields up, dollar weaker. The 30-year through 5%, yields higher by 7 basis points, 5.01% on 30s. And in foreign exchange, the dollar weaker against everything in G10. Euro dollar a 1% move, 112.73.
Yeah, basically just turning up the volume on a narrative that Moody's really highlighted over the weekend, which is that the U.S. has a fiscal trajectory that feels unsustainable. This is coming off a really big week of gains last week. This falls into this narrative of whether the current trade cycle and how much has the world changed. Real question that I have is, are we just ping-ponging from narrative to narrative? And have we settled on which is the bigger risk right now? The growth shock or a potential positive policy mix that could surprise to the upside? And right now it feels like the market is toggling between the two from day to day.
The tug of war continues. What we can say is that downgrade collides with a big effort down in Washington, D.C. to advance a major tax bill in the nation's capital.
So they advanced out of one committee last night. They're going to meet Wednesday, and then if potentially advanced out of there, it goes to the floor. But this is going to be hurdle on top of hurdle. And right now, what we've been saying all morning, the fiscal hawks have momentum behind them. They didn't vote yes, they just voted present. And two of those individuals are going to be there on Wednesday. And they have more momentum to say this is not doing enough to cut our spending.
How much relief will consumers get? This week is a big week for retail earnings. Home Depot, Target follows Walmart last week. Walmart basically telling the world that they can just about hang on before they have to pass on higher costs to consumers, potentially in the next several months. And you got major pushback over the weekend by the President of the United States.
And then it was softened by Treasury Secretary Scott, who basically acknowledged that, yes, they would eat some of the tariffs and their profit margins, Walmart, but they would probably pass some along to consumers. It seemed to almost, as Neil Dutta pointed out, tacitly acknowledge that it wasn't going to be paid for by the exporter. It's going to be paid for in some degree by U.S. companies and by the consumer, which raises the question about how much this allows Target and Home Depot to do the same. They might not say it's due to tariffs. They could just say, we see pricing pressure across the board for exogenous threats that we have, macroeconomic babble.
Dynamism and all that stuff, yeah.
One interesting point that the Treasury Secretary brought up, that Lisa, you just brought up with Neil, is the price of oil. He said that the CEO of Walmart told him the most important price for consumers is the price of gasoline. He says this administration got the gasoline prices down, but not so much as the president continues to say $1.98. I still have not found a single gas station that's going for $1.98 a gallon.
Those retailers this week need a heavy dose of McKinsey, don't they?
Oh, yeah.
This could be a PR nightmare.
Well, except on the flip side, they could say, we love the strong American consumer, America, Von America, and
Have you
look
seen
at all
how
these
many
things.
commercials are out there at the moment?
Totally. Everyone's trying
Autos,
to do this. Exactly.
Manufacturers, Mercedes, their home is in America.
I mean, so this is going to be...
And they all start with how many people they employ in the United States.
So expect more of the same, and then expect marginal pressure because of that strength on prices.
Well, Flexport's Ryan Peterson made a really great point to me when I was in D.C. a few weeks ago. He said Amazon should have flipped this on its head. Put a sticker on everything that was made in America and forced that out to its clients. Instead, it took the opposite approach and got absolutely bamboozled by this administration.
Walmart getting ready to roll out some commercials, I imagine, in the next couple of weeks.
Can you imagine?
Equities right now in the S&P, negative by 1%. Yields are higher, the dollar's weaker. Coming up, Venu Krishna of Barclays. The stocks struggle to extend a 5-day winning streak. Scot Ciccarelli of Truist looking ahead to this week's retail earnings. And Yelena Shulyatyeva of the Conference Board on rock bottom consumer sentiment. We begin this out with stocks lower following a U.S. debt downgrade. Venu Krishna of Barclays writing, with hard data still resilient, deficit concerns building, and the Fed in no rush to cut, rising 10-year Treasury yields pose a challenge for equity valuations. Venu joins us now for more. Venu, good morning.
Good morning.
You and the team at Barclays don't have a recession call, you have a slowdown call. And you've had that slowdown call for quite a while. Put it together with all of that. What does it mean for equities?
Yeah, just to be clear, our economists had a recessionary call in Q3 and Q4, which they changed recently as the news on China-U.S. trade came in, right? So yes, but our view broadly, the beginning of the year was a moderating of growth, and that remains intact, right? And for equities, it's been very complicated. At the beginning of the year, that setup actually looked pretty good for us because we were expecting earnings to accelerate 11 to 12% this year, better than last year. That changed as the tariff narrative took over. And in fact, when I was here about 6 weeks ago, we cut our earnings number to 262, right? And I think I'm quite comfortable with that because we've gone through a lot of ups and downs. It's been a roller coaster, but it is a fact that tariffs are higher than what they were before. And companies are really struggling to deal with it. And there are 4 or 5 different avenues they're using. And I think that is what is going to show up in earnings. First and foremost, they are taking a margin hit. If you look at retail, pharma sector, medtech, the list goes on, they are absorbing it. There are a handful of areas where they're increasing prices, like part of industrials, and a select retail where there's a brand and things like that. On the other hand, companies are trying to push some costs onto their supply chains, for example, right now. Some of them are on an ongoing exercise of trying to move the supply chains out of China, right? And more importantly, in the near term, everybody's stacked up on inventories, big time. That's why you saw Q1 GDP going to negative territory, because imports have exploded.
So to what extent do you think front-loading is masking some underlying weakness in this economy? It is, absolutely. I think what's going to happen is the front-loading is going to ease, and that's why I feel at this point quite comfortable that expecting a earnings sort of recovery back to where we were at the beginning of the year is an unlikely scenario, because while tariff uncertainty has eased, I think companies still don't know how to plan for it. These are big decisions, especially on capital spending. So the pressure is eased, but the upside catalyst for earnings is not as robust as it was. Meanwhile, coming to your original point when you were reading out, I do think that the 10-year rates starting to creep up. They've been up 30, 40 basis points in the last few weeks, is once again going to act as a source of constraining equity multiples, which have recovered quite nicely.
So you see more downside risk right now than upside risk at a time when you've got both the pressure from the 10-year, but also pressure on the downside from margin compression and potentially slower growth.
Yeah, I mean, it's a mixed bag on the earnings one. On the one hand, like I said, the 262 earnings number is respectable. It's still up 6% compared to last year. But where I struggle with for it to reaccelerate back to where we were expecting at the beginning of the year, mainly because of some of the ongoing concerns on margins. I think on the multiples front, the story is far, far more interesting because we saw a massive derating in equities over the last 6 weeks, or call it 3 or 4 months. Now, for the bulk of S&P outside of tech, it's pretty much recovered. In fact, that some pieces of market are half a turn or so ahead of where they were at the beginning of the year. Big tech, which was a source of derating, which derated more than 30%, is still about 4 handles cheaper compared to where they were at the beginning of the year, at a time where they posted exceptional earnings in Q1 thus far. 6 out of the 5, 5 out of the 6 have done really well. So I think it's a mixed bag as far as the equity market is concerned.
This is fascinating because at the beginning of the year, everyone was saying you need to go to equal weight, not market weight. That is where you have to go because you have to expect that the outperformance is going to come from the other areas. Have we flipped that on its head? Where suddenly, when we await for some of these retailers to come out and explain how they're going to be taking a margin hit, now people are going back to market weight because big tech's going to drive the ship.
Exactly. In fact, I'm so glad that we didn't change our call on big tech, right? So, because the reason was simple. Even with decelerating earnings at 16%, we felt that is still fantastic compared to the rest of the market. Now, what actually happened is important to figure out. As we came into the earnings season, consensus came down to under 15%, so modest coming down. But for the rest of S&P, it was scaling down much harder and below long-term trends. Big tech earnings right now are 27%. 12 percentage points ahead of where consensus was. So I think, the fulcrum of this market has been big tech, 30% weight, 25% of S&P earnings. And if that cracks, the point is that correlations to the rest of the market also tend to typically increase. So I think big tech being in the driver's seat is actually a very healthy sign for the market that's not going to collapse.
Big tech was the star of Trump's Middle East tour. Jensen Huang was at every single stop. An individual, though, that kept getting called out by the president was Tim Cook of Apple. Do you like certain tech names because of their relationship right now with this White House?
Well, I don't want to go into single names. I like to think of big tech as a group, right? And one thing I would say to your point is that if you look at the historical correlations between these 6 stocks, it's been 40 to 50%. So at different points in time, a particular stock or a handful of them were better positioned. So clearly, when you talk about certain names, like for example, you mentioned Apple, they have a significant exposure to China, right? And they are looking to get out of their, or diversify their manufacturing base. So those are ongoing concerns the market will have to deal with. On the other hand, we have idiosyncratic things, like there are issues our analysts have pointed out of whether the server useful life depreciation actually reflects the change in technology pace right now, right? So I think big tech has its set of issues right now, but in aggregate, when you look at names, Google, Meta, Microsoft, all of them are in a much, much better position than what the worst case scenario was, right? And the big narrative I heard, for example, when I was in Europe, call it 2 months ago, that everybody was saying the AI productivity story, is faded. And our point is, at least in software productivity, it's a tangible 30% improvement. So if you're a tech-centric business, that is very real, right? And what you're finding now is some of those productivity benefits are percolating across the economy, not at the pace you want, but still slowly percolating.
Venu, did you find it a harder sell this time around in Europe to sell the US equity story to the Europeans?
Oh, absolutely. When I went, I think part of it is an emotional trait, right? I think our approach has been so, what's the term I'm looking for, aggressive, that I think that has a visceral reaction, which shows up in let's fade the US and let's focus on home. But I would argue at this point in time, that trade has probably played out. With the moderation in the tariff story, and with the narrative finally shifting towards some of the growth policies, even though that's creating concerns around deficits, for example, I do think that that story is changing. But it is a fact that if you put the aggregate of the policies undertaken right now, most of the world wants to diversify in a meaningful manner, while keeping a healthy exposure to the U.S. There's no way you can cut exposure to the U.S. and get respectable returns, certainly in the equity markets.
Venu, it's good to see you. It always is. Thank you, sir. Venu Krishna there of Barclays. A lot of people writing notes this morning about buying the dip, not just Mike Wilson and Morgan Stanley, but just moments ago, Max Kettner of HSBC saying this bond market move doesn't constrain this equity market until you get into the danger zone, and he believes that's a 10-year closer to 4.7%.
Yeah, which goes back to the question that you were asking before. Is this really a dip? Is this viable? And when you look at what's going on with respect to stocks, but it points to how people are seeing this as something very transitory. I felt really bad. Very, short-lived. People felt like there was going to be some sort of change in narrative. I'm just
Chairman Powell words all over the place. Put some meat on those bones. This from Max just moments ago. We'd view any fall in risk assets as an opportunity to scale up exposure. Seen that in a few places already this morning. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira Anand. Hey, Yahira.
Hi, John. The House Budget Committee approved President Trump's tax and spending package after Republican hardliners won agreement from party leaders to speed up cuts to Medicaid. The bill now heads to the full House and then to the Senate, where the deeper Medicaid cuts and other provisions face scrutiny, if not outright opposition. Meanwhile, the New Jersey transit strike is over, but train service won't resume immediately. The Brotherhood of Locomotive Engineers and Trainmen approved a deal Sunday night to end New Jersey's first rail strike in 40 years. But rail operations are not set to resume until tomorrow. Because of that, New Jersey Transit encouraged commuters to work from home today, if possible. And sad news, former U.S. President Joe Biden has been diagnosed with an aggressive form of prostate cancer that has spread to his bones. Biden posting on X this morning saying cancer touches us all. Like so many of you, Jill and I have learned that we are strongest in the broken places. Thank you for lifting us up with love and support. That's your Bloomberg Brief. John?
Yahira, thank you. Thanks for the update. More from Yahira later this hour. Up next on the programme, the Morning Calls Plus, Scot Ciccarelli of Truist looking ahead to this week's retail earnings, including Home Depot and Target from New York City. You're watching Bloomberg TV. The opening bell's 1 hour and 12 minutes away, and equity futures are down by some 1% on the S&P 500. On the Nasdaq, we're down by 1.5. We've basically had almost a 20% rally off the lows of April. We had a 5% plus move last week on the S&P, close to 7% on the Nasdaq 100. We're down by 1 to 1.5%, and there are notes out there talking about buying the dip.
Right. This is the question. Is this a dip? Is this a viable dip? Is this something that even counts as anything, given the fact that we saw a 9% gain last week in just the Magnificent Seven stocks alone? It seems like maybe that's the case. Load up on risk assets, according to maybe Max Kettner and Mike Wilson over at Morgan Stanley.
Outside of equities, bond yields are higher. The 30-year through 5%. The dollar's weaker against everything in G10. That's the price action. Here are your morning calls. First up, Barclays upgrading Williams-Sonoma to equal weight, saying the company's raised prices could provide, quote, tariff cover. Williams-Sonoma is down by 1.3%. Next up, Stifel cutting its price target on Lowe's to 250, highlighting a wait-and-see approach after a softer start to the year. And finally, Evercore adding Home Depot to its tactical outperform list ahead of earnings tomorrow, expecting sales guidance to move the stock higher. Sticking with retail, busy week of earnings kicking off with Home Depot, followed by Lowe's, Target and TJX later this week. Scot Ciccarelli with a word of caution on Target, writing the company was already in a very challenging position before the tariffs and now faces significant risk to what was already expected to be a soft year. Scott joins us now for more. Scott, welcome to the program, sir. Let's talk about the weakness already for the months ahead and how the tariff situation could just reinforce that weakness.
Well, I think you've had a couple things happen. First of all, February, early March, the weather was absolutely horrid for a lot of companies. You had a little bit of, let's call it a Christmas hangover, a lot of spending, right around the holidays, and then you get deeper lulls in between. And then, you had a later Easter on top of it, and then you have all the geopolitical situation. So you've had kind of a rough first quarter, but for most companies, I'd say Target's actually one of the exceptions. Sales trends seem to improve during the course of the quarter.
Scott, how do you think they managed inventory? They've been in positions where they've had too much and not enough. And we've seen big stock corrections. I remember May 2022, I think it was, coming out of the pandemic where we had that massive gap lower. Scott, how do you think they've handled things this time around?
My guess is it's going to be pretty lean. I think a lot of companies, they want to make sure that they're playing relatively cautious, especially with the geopolitical headwinds, the way we've seen them with all the rhetoric coming out of D.C. So my guess is retail inventories will be reasonably lean, and I don't think you're going to be facing a lot of markdown risk. That's really what threw people off back in 22, as you mentioned. And so I don't think companies want to get back into that same spot.
Will they be eating the tariffs, as the president, the Treasury Secretary says, when you think of the likes of Walmart?
Well, my guess is every company is going to try and manage it a little bit differently. I mean, the general playbook says you push back as much as you can onto the vendors, then you're going to have to eat a piece of it, and then you're going to pass on the rest via price increases. And each company is going to try and find, what's that optimal, kind of profit strategy. Specifically for Target, I do think they'll have to eat some of it, because otherwise you're going to be in a situation where your price gaps versus Walmart versus Amazon is just going to continue to blow out much wider and puts you in a really tough competitive position.
Scott, a week ago, we basically had this détente with China lowering the tariff rates. The president, over the course of the week, was talking about a number of countries want to do negotiations, and if they don't get to an end game, they're just going to set a new tariff rate. Is there a thinking in the retail space that by mid-July they will have clarity?
I don't know if there's an actual time frame associated with it, but I do think you saw companies like Walmart, like Target, like Home Depot, basically delaying shipments from China, hoping that in a couple of weeks you'll get some sort of clarity. Now, eventually, where it ends up, is it July, like where kind of the 90-day pause will get full clarity? I think that's certainly the hope, but there's no guarantee. I mean, we've seen kind of tariff commentary change not just week to week, but day to day. Right. So in that kind of environment, I think you try and manage your business as well as you can, and you kind of hope for the best, if you will.
How much is Walmart taking advantage of this moment to really steal market share at a time where they already have been? And arguably, that's Target's biggest issue right now.
Sure. I think Walmart is really putting the pedal down, if you will, and trying to open up price gaps as much as they can. Here's a stat for you. Since 21 relative to 25 estimates, Target will not have grown their sales base, whereas Walmart will have grown their business by almost as much as Target.
Oh my gosh. So this is the reason why people are actually looking at Walmart and seeing them as both the leader when they come out and saying they're going to pass along some price increases, but also the big competitor. And we're talking about not just Target, but also Amazon, also a lot of the grocery stores. I'm just wondering how much you see that as the environment that we're in, a winner take all. It's not going to be Home Depot and Lowe's. It's going to be one or the other. And it's going to be a real sort of reckoning for any players that have a strategic advantage or not.
Yeah, look, I think there's some verticals, retail verticals, that are a little more insulated than others. You can call it home improvement, you can call it auto parts, et cetera. But, to your point, whether it's, Amazon, Costco, Walmart, they are scooping up the vast majority of that general merchandise sales between the three of them. And, that becomes a really tough situation for competitors to operate in. And what Walmart has done is, very similar to what Amazon did in terms of building all these alternative revenue streams, be it membership, third-party marketplace, advertising, et cetera. And so they're actually helping subsidize the core retailing business, buying something from a vendor, selling it to a consumer. And when you do that, and they're driving their own margins down, despite retail margin down, despite this massive sales growth, it just makes it harder and harder for all the smaller companies to operate in.
Scott, just before you go, I wanted your thoughts on how to approach earnings season in the C-suite and how things have changed. It just feels like such an unusual moment. They have to decide whether to scrap guidance, keep guidance, cut guidance, offer dual guidance. And Scott, now they need to think about how to talk about pricing with the president breathing down their neck. We saw a report from Amazon a few weeks ago on Amazon that maybe they'd break out the tariff costs. The president calls Jeff Bezos. Then all of a sudden we see from Walmart they talk about higher costs and maybe passing it on to the consumer. And the president has to call the Treasury Secretary, who then calls Doug McMillon of Walmart, and then the president's tweeting over the weekend about it. Scott, how unusual is this for retailers in America, and how do you think they're going to approach things this week?
Well, let's face it, it's unprecedented in modern times, right? Like, we haven't had this kind of price increase. I mean, we've dealt with, whether it's the GFC, whether it was, COVID, we've dealt with various emergency scenarios, but we haven't faced, a tariff scenario the way we're looking at it. So what I can tell you is, companies, some are just choosing to scrap guidance. Some have tried to provide some sort of parameters. If this becomes the tariff rate, then this happens to our sales or earnings. Other companies, early on the stage, it's just like, look, we don't really know, so we're going to continue to guide without tariffs for the moment. And then as tariffs start to impact our P&L, then we'll start to revise what the expectations are. Now, investors, they've got to make decisions in kind of before that. So I think that the investors and people in our seats, they're really in a tough situation of trying to handicap what the impacts are going to be.
The calls could be more interesting than the numbers themselves. Scott, appreciate your time, sir. Thank you. Scot Ciccarelli there of Truist. Up next, we'll talk about the consumer with Yelena Shulyatyeva of the Conference Board and Krishna Memani of Lafayette College as consumer sentiment hits rock bottom. The open about 60 minutes away, coming off the back of a 5-day winning streak on the S&P 500 and snapping it quite cleanly this morning. On the S&P, we're down by 1%. On the Nasdaq 100, we are lower by 1.5. In the bond market, yields are higher on a 10-year and a 30-year by 6 or 7 basis points, close to 8 basis points higher now on a 30-year bond yield, back through 5%. Following the downgrade from Moody's, losing the last rating of a AAA credit rating over at the United States, and that unleashes some higher bond yields and a weaker US dollar. Euro dollar 112.64, positive by 0.9%. Worth pointing out where we have been, though, over the last week or so, both in equities and in foreign exchange. Stocks have had a monster rally, 5% plus on the S&P just last week, and the dollar over the last month rebounding, just shown some strength, Lisa, over the past few weeks.
Which is a reason why Mark McCormick had a great point, which is maybe what is to watch is not necessarily the relative performance as much as the direction. And if this type of correlation continues with a weaker dollar, higher yields, and potentially a sell-off in risk assets, that's when people start to take notice about a longer lasting trend in terms of a shift away from the United States.
This mix spooked people a few times in April. You're seeing a repeat of this mix this morning, and we'll see if it continues. Certainly, that's what it looks like this morning. Bond yields are higher, dollar's weaker, Equities are lower. With 60 minutes until that cash open, let's get you some morning movers with Danny Berger. Hey, Danny.
Hey, John. And with that equity lower move, it is big tech. It is Mag 7 that seems to be leading us on the way down. In some ways, it makes sense. It's what led the way up yesterday. Maybe it's longer duration stocks like tech that you start to get worried if bond yields are bumping up around 5%. Nvidia down 2.8% with that sell-off, despite the fact Jensen Huang was in Taiwan at one of Asia's biggest electronic forums, touting new technology, that vastly being overshadowed by the macro story right now. We do have a little bit of deal news. A few hours ago, BlackRock confirming earlier Bloomberg reporting that they will be buying TXNM. This is a New Mexico power supplier. Those shares jumping 9.3% with news of that take private. The price tag on that is $5.7 billion. It's a real trend we've seen. A lot of investment being made in power supply with more energy demands, more electricity demands, especially with data center growth. Now, finally, rounding things off with Netflix, getting a downgrade from JPMorgan this morning from overweight to neutral. The analysts there saying, look, we're not long-term bearish on this. We're still bullish on the stock, but it hit a record price on Friday. It's run up more than 30% this year. Basically, all of the good news for 2025 is already priced in, so those shares falling 1.8%, John.
Danny, thank you. Appreciate the update. Danny Berger there with your movers going into the opening bell. Busy day of Fed speak coming up as well. Mike McKee, our economics and policy correspondent, will be conducting some of that. He joins us now from the Atlanta Fed conference. Good morning, Mike. What's the focus over there?
Focus over there is the same as the focus as it is in New York and around the world, and that is what happens with U.S. markets and where do we go with tariffs. The uncertainty premium is built into every conversation. Nobody knows where we're going with this. Raphael Bostic was on CNBC earlier this morning and said that it'll take 3 to 6 months before it becomes clear enough for the Fed to know what's going to happen, and that is basically the feeling here. And you talk to the investors who are here, and they're thinking we just kind of sit on the sidelines. It's a little risky to start putting on any specific tariff-related trades because you don't know what the president's going to do minute to minute.
Mike, we've just had repeated policy shocks, and it really started for most people on April 2nd with Liberation Day and these massive tariffs that for many were unexpected. Now the attention has shifted to the tax package going through Washington. What are the thoughts that are slowly evolving, quickly evolving, given the weekend's news on that front?
Well, basically, the feeling is it's going to be a stimulus to the economy in 2026 because they're putting a lot of benefits to people into that, the child care tax credit, the no tax on tips, that sort of thing. And so we should see a bit of a tailwind. The question is, can that overcome the headwind that comes from people paying more because of the tariffs? So there's kind of a confusion about that as well. And it does weigh on the Fed when you talk to Fed officials. It's just one more thing they have to try to figure into what they're doing and what they think is going to happen because, of course, monetary policy works with a lag. The downgrade, Lisa put it well, the downgrade has everybody looking at what's going to be happening first in the bond market, then to the dollar, and then to the equity market. And if everything goes south there, that adds another weight onto it with the wealth effect impacts and the consumer confidence impacts. So this is a really uncertain time, perhaps the most uncertain time any of the folks here have seen.
Mike McKee, looking forward to your conversation, sir. Look out for the Atlanta Fed President, Raphael Bostic. Speaking to Mike McKee later on this afternoon, 2:45 Eastern Time. Let's stick with the economy. Yelena Shulyatyeva of the Conference Board writing, we expect hard data to move closer to the soft data in the coming months. April retail sales is just one of the first signs. Yelena joins us now for more. Yelena, good morning.
Good morning.
Why do you believe the soft data is leading data and not misleading data?
There's a lot of noise in the data, of course, and the recent gap between the soft data and the hard data has been really tremendous. So I think it just takes time. It's a time differential. So I think we're going to see hard data moving down to the soft data. Why? I think just simply because consumers are concerned. They're concerned not only about tariffs, they talk about it all the time, but they're concerned about their jobs. They're concerned about the state of the labor market. So we are going to get another update on the Conference Board Index of Consumer Confidence next week. And the thing that I will be looking at is the differential, the labor differential, the things that consumers say about the labor market. In the April survey, that survey showed the worst first reading on consumers' share of those who say fewer jobs will be available over the next 6 months.
How does this contrast with what companies are saying and how CEOs feel about the situation?
Well, we're going to find out about it again on Thursday, May 29th, when the CEO Outlook survey will be available from the Conference Board. So the latest survey, which was released back in February, showed a big increase in confidence among CEOs. And we're going to see if that is going to change, because we had quite an interesting 3 months period.
How long do you expect this policy uncertainty to last?
For a long time. I don't see that abating this year. So we're probably going to see some decline, some abatement in the trade-related policy uncertainty. But we're going to see other types going higher. So sovereign debt uncertainty is going to be on the rise. Fiscal policy uncertainty, here's another one. So I think we're going to see these waves, like one type going into the next one. And I think that will affect both businesses and consumers.
What you see in the surveys, does it mirror any other time in U.S. history?
Well, some readings are really concerning, because they go back to the COVID time, they go back to the Great Recession. And that, to me, is a little bit more concerning. If people see the labor market at the point that they thought about it back during the Great Recession, that's a concern. We're not at that point in the hard data just yet, but we may see some freezes in the hiring going on to continue.
So it feels like we've been flipping back and forth, depending on the day, about whether it's a growth shock or whether it's a positive policy shock that's going to cause some of the sentiment. And we've seen recession both be a base case for people, both be pushed off into a more remote case more recently with the policy shift when it comes to trade. Why are you still more squarely on the growth shock, which potentially could even percolate into recession?
We never expected a recession in our baseline case. We actually expected a significant slowdown, and this is what we continue to expect. And there are different things. So consumers, they're already telling us, and they're already showing us actually that they are going to step back, right? Businesses, are you going to do your capex if you don't know what's going to happen? Housing is another one, again resurfacing today with mortgage rates going higher and delinquencies on the rise, right, because of what happened with forbearance regulations.
Well, here's what people are having trouble with, people being myself. We have people like Bank of America come on. You have people from Citigroup come on, and they say credit card spending pretty much at the same level that it has been. People are still spending. You hear from the retailers, a lot of strength, a couple pockets of weakness, but otherwise consumers remain resilient. What is it this time around that's going to make the soft data that much more relevant than it was, say, 2 years ago, when it wasn't as much of a leading indicator as it had been in the way past?
Inflation. That's the answer. So the University of Michigan survey, the cutoff was before the Walmart, announced they're going to raise prices. So the Conference Board survey, the cutoff date is this week. So that will include that announcement. So when consumers start seeing prices going higher, they're not going to be happy. They will pull back. And I think businesses, too, like a lot of uncertainty about all these different things that are happening, is going just to put a speed limit on how much they spend. So
you don't think the trade truce between the US and China does some work to unravel some of that?
I think, maybe, potentially, but, I think it's already behind us. The news flow is so intense that, a lot of other things happened since then, and that could, affect uncertainty.
That was only a week ago, and it feels like a lifetime ago already, right?
It was. I think I was a different person last week. Tomorrow I'm going to be ChatGPT.
The speed of this news flow is just absolutely unreal. What a news cycle. Yelena, good to see you.
Nice to see you.
Yelena Schulyatyeva there of the Conference Board. We need to turn to the bond market. Krishna Memani of Lafayette College with this to say: I still like bonds despite the recent pain, for the simple reason that I think inflation will not be as significant an issue as the markets expect. Krishna joins us now for more. Krishna, welcome to the programme, sir. Before we get to tariffs and inflation, downgrades. How relevant is that downgrade from Moody's, if at all?
Well, so I think Besant is right on this count. That is, the downgrade itself should have happened a while ago, and it really isn't much of a driver of anything in the market. I think if the downgrade had come when S&P 500 was at, let's say, 5,400 or 5,600, I don't think we'll be talking about in terms of impacting equities and risk assets very much.
But Krishna, as you know, it's coming after a big conversation through much of April about the future of the safe haven status of the United States following a big policy shock on the trade front. And that's raising questions about the future of a tax bill advancing down in Washington, D.C., and what it means for fixed income going forward from here. What do you think it does mean?
Well, so I think the real issue for the economy right now is, as Yelena was talking about, is really the slowdown and the tax bill. But it isn't tariffs, and it isn't really the impact of the fiscal deficit that much on the state of the economy, or even the dollar for that much. So I think what we are talking about here is the tariff situation will get resolved. The tax bill probably gets passed, but with lower level of fiscal expansion in 26, 27 than what we are expecting right now. That's really not a bad environment for bonds. And especially in the light of the fact that inflation is really not going to be that big a deal. It's, tariffs impact in price levels, but it's really not as inflationary as people are thinking in terms of. It's a consumption tax rather than inflationary. So if that is the case, inflation is not a big deal, and real rates are high, and you end up with a tax package that is more reasonable rather than meaningfully expansionary. I think that's not too bad for the bond market.
So, Krishna, are you buying 30-year bonds?
Well, so, in our allocation, for example, for an endowment, for example, what we are focused on is really the long-term return of equities and private equities in particular. So bonds, bonds are interesting, but we can generate bond-type returns out of low-vol hedge funds just as much. So, no, we are not buying it. In my private portfolio, yes.
Okay, so here's my question, Krishna. Why does it not concern you at all that we have a toxic brew right now where you have bonds selling off, stocks selling off, and the dollar selling off in tandem at a time where people are making a lot of noise about the fiscal deficit?
Well, so I would say that you have to put it in a bit of a context. That is, all of this is happening after a significant rally on all of those things over the last month and a half. So, we are taking profits rather than rethinking the basic strategy here.
Krishna, when you talk about in your notes that you don't foresee a recession but a slowdown, what would make you reconsider that actually the U.S. could tip into a recession?
Well, if the tax bill doesn't pass and tariffs get implemented, that's a fiscal consolidation for the history book. So I think that really would get us into a recession. If we have a reasonable tax package, and the fiscal consolidation is, there isn't as much fiscal expansion, I don't think we get a recession.
Well, that's already baked in that we're going to get an extension of TCJA. The issue right now is potentially, a lot of people talked about how this was a removal of a headwind, but does this actually offer some risk given the fact that we have this Moody's downgrade?
Well, so I would say the fiscal consolidation, or the tax impact effectively of tariffs of, let's say, 1% in GDP without any corresponding expansion on the tax package. If it is just a renewal of TJCA, then that's a different equation than what we are talking about right now with the current bill.
So right now, you see that there is a downside risk to growth. You see it because there is not necessarily more fiscal impulse coming from from Washington, D.C. Going forward, is this going to be something that can sustain some of the private credit, the private investment that's been ongoing in the U.S. economy? Or do you see something of a very difficult time, the fact that you are going to private assets?
Well, so, I think private credit and things like that are really a reflection of credit growth and the fact the disintermediation at the bank level. If the Fed is really effective in changing bank regulations in a meaningful way, again, it's an open question whether they will away from, just giving them a little bit of room to buy treasuries. I think if that happens, the expansion in private credit probably comes to, the growth, it probably stops to some extent because banks will have an opportunity to do a lot of things. without that, if the U.S. economy and U.S. corporate sector is as good in shape as it has been over the last 2-3 years, I think private markets probably continue to do, from a growth standpoint as opposed to return standpoint right now, probably continue to do just fine.
Krishna, always wonderful to hear from you, sir. Krishna Memani there of Lafayette College on what he thinks of the bond market right now. Doesn't seem too concerned about what we've heard from Moody's, and I have to say, after 3 hours of programming this morning, he's not alone.
Well, nobody really particularly is going to take a forward look from Moody's. It just kind of emphasizes a narrative that people can cling on to this morning. And as he said, it's basically, after we saw this rip-roaring rally in all these asset classes, there's some profit taking that a lot of people are lining up to buy, evidently.
Puts a massive spotlight on the process emerging in Washington as they try to advance that big tax bill.
Right, and this process is going to be really challenging. I know Speaker Johnson has this Memorial Day goal. Potentially they'll get there, but then it goes to the Senate, and it's going to be incredibly challenging because of so many different factions evolving. The SALT caucus, the Medicaid caucus, the green incentives and renewals of potentially or rescinding of the Biden-era tax credits. This is going to be really challenging, and they want to get it done by July.
You think that's too aggressive?
It depends. If the president continues to jawbone then and send out troops and start putting the calls through, and Tyler made a great point. It's so big, everyone can latch on to at least something they got out of it, and potentially that's what we'll see.
Well, the fiscal horse can latch onto this. The 10-year yield that's higher by 7 or 8 basis points, back through 450, and Lisa, a 30-year that's now at 5.03% and higher on the session by close to 9 basis points.
Kevin Hassett speaking on another news outlet coming out and saying the U.S. debt is the safest bet on earth. Moody's decision is backward-looking. That talking about trade deals, I mean, this is all going to be a lot of noise as people try to position this in a way that seems benign.
A lot of people believe, with reason, that U.S. assets are the centre of the market universe. And if they're not AAA, what is everything else? And I think that's a question we've got to ask. Do you really believe that you can get a bond market sell-off in isolation, in the Treasury market, that just sits there on an island and everyone else is OK? I'm not sure that's how the market works.
And it's not how it's working this morning. You can see yields around the world that are increasing. You have seen the Japanese yields blowing out as well, in addition to German Bund yields. So it starts to raise the question, is this really a United States story or is there something bigger? And to the extent that the U.S. isn't exceptional, everything else isn't amazing because everything else has been pinned to the exceptionality of the United States. So this is the sort of conundrum for markets that people are grappling with.
The 30-year bond yield this morning higher by 9 basis points, 5.03%, with an update on stories elsewhere. With your Bloomberg Brief, here's Yahara.
Hi, John. As you've been discussing all morning, Moody's stripping the U.S. government of its top credit rating. The agency lowered the U.S. by 1 level from AAA to AA1 on Friday. Moody's cited the failure by successive administrations to deal with rising U.S. debt and deficits. Treasury Secretary Scott downplayed concerns over the downgrade, saying Moody's is a lagging indicator. Meanwhile, President Trump is set to hold a phone call this morning with Russian President Vladimir Putin. That's after Ukrainian President Volodymyr Zelensky met with Vice President J.D. Vance yesterday at the Vatican. Secretary of State Marco Rubio says President Trump is prepared to back new sanctions on Russia if today's talks don't go well. And the first Subway Series of the year was electric between the Yankees and Mets. The stakes were already high between the rival first-place teams, but the weekend series had extra flair with former Yankee Juan Soto returning to the Bronx for the first time as a Met. The Yankees won the series 2-1 after an 8-2 win last night. That's your Bloomberg Brief. John?
Yahara, thank you. Do you want a final word on this? Is that your final word?
$765 million for Juan Soto. What did he deliver? Really nothing. 8-2 blowout. Absolute blowout last night. Incredible.
How much do you like that mug?
I love this mug.
Great, we're going to break it.
OK, up next on the programme, we'll set you up for the week ahead. Commercial break should be fun. Live from New York, this is Bloomberg. The opening bout just around the corner, 37 minutes away. Equities sliding by 1% on the S&P, down by 1.4 on the Nasdaq. Your trading diary, your week ahead looks like this at 9 a.m. Eastern Time, a White House press briefing. Look out for that. 1 hour later, President Donald Trump holding a phone call with Russian President Vladimir Putin. 2:45, Atlanta Fed President Raphael Bostic speaking with Bloomberg TV. Tomorrow, Home Depot earnings. Wednesday, Target results. Thursday, PMI data and another round of jobless claims. And through the week, a big conversation about this tax bill. Joining us from the White House is Tyler Kendall. Tyler, talk to us about next steps to advance this bill.
Yeah, hey, John. Well, the House really needs to get going when it comes to negotiations if they want to end up passing this through the Rules Committee by a 1 a.m. Wednesday vote. Of course, one of the big things on the table here is what's going to happen when it comes to extending or moving up those work requirements related to Medicaid. I actually just caught up with NEC Director Kevin Hassett here at the White House, and I asked him if the White House would support that timeline, moving it up. And he said that they will do whatever it takes to get this reconciliation package through, because at the end of the day, this administration really is banking on these tax cuts getting through the House, excuse me, in order to fulfill the rest of their economic agenda. That's one sticking point that we're watching closely as negotiators get going on Capitol Hill.
Tyler Kendall, thank you. Tyler, appreciate it. That bill's advancing down in Washington, D.C. Will this bond market have something to say about it?
Yeah, well, it's already having something to say about it, maybe on the margins. Is it enough to get some attention in Washington, D.C.? That remains to be seen. It does seem like people are trying to pick up the bond vigilante mantle just a touch. Nobody seems to want to buy 30-year yields, even when you end up with somebody, Krishna Memani, who likes duration. You can find it in other places.
But where has everyone been? We've known that this bill is going to cost some $4 trillion over the next decade. That has not gone away. Potentially, maybe they see it actually coming to fruition. How quickly we've seen these four ultra-conservatives basically say, we're going to allow this to sail through. I still think this is going to be incredibly challenging. The margins are just too slim, and everyone is asking for something that, once you give it to them, creates a whole other problem for the Speaker of the House and the President of the United States.
What a way to start the week. Live from New York City this morning, a big morning already in the equity market, a correction after a 5-day winning streak on the S&P 500, a 5% plus rally on the S&P just last week. We pulled back 1%. In the bond market, though, this is what gets your attention, the mix between what's happening in fixed income and foreign exchange. A 10-year yield higher by 8 basis points, 4.55. A 30-year bond yield higher by 8 basis points, 5.02%. Combined with not dollar strength, but dollar weakness. And that's what spooked us back in April. And it might be spooking some people so far this morning. Coming up tomorrow morning, Ed Yardeni of Yardeni Research, the man who literally invented the phrase the bond vigilantes, will be joining this program. We'll catch up with the former World Bank president, David Malpass, Philippe Singh of PGIM Fixed Income, Jim Karen of Morgan Stanley. From New York City this morning, good morning to you all. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.